9 a.m. live from our brand new studios in New York City. I'm Shauna Smith alongside Brad Smith and Brian Zazi. This is Yahoo Finance Live. Here's what we're watching this morning. Government shutdown risk. The latest test for House leadership is underway as lawmakers scramble to pass a funding bill before the end of the week. Polarization on the Hill is a long-term concern for Moody's, the ratings agency, lowering its U.S. outlook to negative.
And we're kicking off Healthcare Week here at Yahoo Finance, taking a closer look at the sector as everyday Americans battle affordability and access. Weight loss drugs have been a buoy for manufacturers as of late, and they may impact more than just patients' waistlines. Novo Nordisk says its blockbuster Wegovy drug could also cut risk of heart disease.
And Boeing is taking off thanks to Emirates, the airliner announcing a new order worth more than $50 billion. Emirates is the biggest operator of Boeing's 777 aircraft, cementing the position with this latest order. But first, we are back. The biggest story, at least here at Yahoo Finance, after months of bringing you this news from the Nasdaq market site and the New York Stock Exchange, we are back in our brand new state-of-the-art studio, guys. Long time coming here. This is next level in terms of the capabilities, what we're going to be able to do within this new space. We got the newsroom right behind us. This is awesome.
Hey, thanks for letting me in here. I appreciate it. But no, I'm actually a little nervous that we are performing. We're talking about stocks in front of the Yahoo Finance newsroom. They can see us through here. But really, Guy, look.
They could see you before.
They could see us by going online. But look, they're walking right now. I see all the all-stars in the newsroom. But look, this studio will help us bring, I think, more powerful stories to the Yahoo Finance community. And let's be real. We had a packed house at Yahoo Finance Invest this week of investors, hundreds of investors in that room trying to understand these markets, trying to get access to some of the biggest guests in the business. And this studio, Studio 770 in New York City, is going to help tell these stories. I'm excited.
One of the things that I'm most excited about is if people, and for our visitors, some of those guests who we had at Invest that are recurring visitors, some of them here on Yahoo Finance who we hope to welcome into this new studio as well, they're going to see a lot of those breakout areas. And our viewers are going to see that as well here because that allows us the opportunity to engage viewers in a myriad of different formats. Content is in so many different places, and in making sure that we're not just here on our Yahoo Finance live feed, which goes into the platform both online and on the app, but also making sure that we have the digestible bits of information that are going all the way into FinTalk or going into Instagram or going, to wherever people want to get financial news at their fingertips or just on their screen.
I kind of want to give away one of these mugs. So if you're watching right now, This is the new Yahoo Finance mug. Just tweet at me. I'll send you a mug. It's okay.
How are you going to pick the winner of the mug?
Well, the first one that sends me a tweet.
Okay, there we go. All right. Well, we certainly have so much to look forward to here at Yahoo Finance. We got to begin with the top story of the day, and that is markets are on high alert. Futures slipping as investors gear up for a very big week of econ data. Key reading on inflation. The consumer price index will give us the latest look on how consumers are holding up in the face of higher borrowing costs. Adding to the cautious tone this morning is Moody's lowering its ratings outlook to negative from stable. The ratings firm pointing to large fiscal deficits as another shutdown deadline looms. That deadline, November 17th, just days away. Taking a look at the market reaction this morning as we kick off a new trading week, we are seeing all three of the major averages here under pressure, perhaps not as much pressure as maybe we were initially anticipating, given that lowered outlook here from Moody's. But I think this points to, going back to YF Invest, Yahoo Finance Invest last week, the summit, a theme that we heard from many of our big time guests there, just in terms of the record deficit, what exactly that could potentially do here to the economy down the line. You talk about the fact that rates trending higher, obviously lowering the affordability here to borrow could be a real problem here ahead for the economy.
It could be, and everybody's ignoring it. Government shutdown. If this happened, when these headlines came out, a couple years ago, this was a big thing for markets, and markets continue to shake this off. But Brad, maybe markets shouldn't be taking this off. We had Moody's late Friday. I was going home to get ready to barbecue myself a steak. Boom, Moody's had that news dump on Friday. What they cut?
Lowered its rating.
Lowered its rating. That's a big deal, and you should care about this stuff. We heard from a lot of leaders at Invest last week. AT&T CEO John Stank, he said he's worried about the deficit. Now, is he going to change how he invests in his company? Not really. I don't think he's going to make that decision next year. But it's a problem.
It is.
And you need to be paying attention to this stuff.
Yeah, and for a lot of our viewers, they're going to hear a lot, and I imagine you, even in hearing this news over the weekend, it made that steak taste a little less good.
It still tasted good, Brad. No, let's be clear. That was a damn good steak, man.
But at the end of the day here, a lot of our viewers are going to learn a quick lesson in this medium period of time here until we get to that November deadline here, November 17th. But laddered continuing resolution, laddered CR is what you need to know about. And this this is what's trying to get pushed through, and it is likely going to be dead on arrival, quite frankly, here, because this essentially is going to be a first bill and kind of two bills. First bill that would look to extend funding that went and would go out as far as January 19th. Funding for everything from the military construction, transportation, housing, energy department. But then you get another part of this bill, and that extends funding out to February 2nd. That includes funding for the rest of the government. And so that particularly is where in a Democratic-led Senate, as well as the White House right now, it is likely going to be dead on arrival in both those instances.
Yeah, exactly. And this is what Moody's is pointing to. We mentioned the fact that they lowered their outlook here for ratings, and a lot of that tied to the division that we're seeing down in D.C. When you take a look at how divided both parties are, even within the GOP itself, when you talk about what, and take a look at what's been going on within the House here over the last several months, the fact that it could be some time before we get any sort of potentially long-term solution to this mounting debt that we have not been able to address in any sort of form recently, that's the big issue here for Moody's and why we saw that lowered outlook.
And now we have lots of folks talking about fear of missing out on Wall Street. That was the front page Wall Street Journal story this morning. And all sorts of stats on this. I mean, the S&P 500 up 9 of the past 10 sessions. I think investors are figuring out, should they get into a market right now when you have deficits at these levels, you have complete chaos down in DC, and it's a worthwhile question, I think, to put forward. But for me, I'm just looking for catalysts. Where are these catalysts for the market to jump in here at these levels? I just don't see it. But maybe that's just me.
And I think that that's one of the issues that a number of strategists, a number of economists have been pointing to, right? When we have this sort of optimism that has returned to the market, at least over the last couple of days. Torsten Slok put out a pretty interesting chart that caught my attention this morning, chief economist over at Apollo, and he was talking about the fact that ever since the Fed started raising rates, obviously this is something you would expect to happen, but the number of mentions of weak demand on earnings calls, you can see it ticking up pretty quickly here after the Fed started raising rates. Obviously, what this points to here, or why we are bringing this up, is in terms of what this could mean here looking ahead to 2024. Yes, there are some individual investors out there who seem to be optimistic. They're finding a reason to buy at these current levels, but there certainly are enough headlines out there that makes you a little bit apprehensive when you talk about declining demand.
Well, one of the huge things here, too, and just a quick nod to that, is this also filters back into cost discipline. That being one of the larger, in a weak demand environment, you're going to hear more about cost discipline from these companies, and that could show up in a few different ways. And one of them is this trend of quiet cutting that we've heard about from companies and some employees who have been, of course, at the core of that quiet cutting that's taking place, the reduction in headcount or restructuring in workforce, where that started to play out as well, even though it may not be announced in the larger forms or larger quantities that we had heard at the start of this year, too.
No, right on, Brad. And Sean, you mentioned 2024. Some of these outlooks are now starting to come into play, and I'm locked in really today. I'm still going through this giant, almost 50-page note from 55 pages, I should say, from Mike Wilson. Now, this is one of the biggest bears on Wall Street, Mike Wilson. He is looking for S&P 500, 4,500 next year. So slight in gains. He sees earnings increasing about 7%. And down here, I think this is really useful for all the Yahoo Finance users watching us right now. Mike is now running screens on certain stocks, which I think are very, very interesting. One screen that he has put up is, I think, highlights some of his best plays or stocks you may want to gravitate towards. That is Meta, that is CarMax. Not really sure about CarMax. They're selling cars at a time of higher interest rates. Not a great place to be. Lululemon has been knocking the cover off the ball. Intuit, they'll report earnings in about 2 weeks. Probably good quarter coming from them. But one of the screens here, first, overweight by Morgan Stanley research analyst, always a decent screen to put forward there. Earnings quality, earnings stability, and a member of the top 1,000 U.S. stocks by market cap. So Meta, Lululemon, Intuit, some of the names that stood out to me.
All right, we've got a lot of other names that we're going to be tracking here as well this morning. Let's take a look at some of the trending tickers ahead of the open. Novo Nordisk finds its weight loss drug Wegovy has another health benefit. The drug cut the risk of serious cardiovascular events in people with obesity and heart disease in a closely watched trial by 20% here. Over 17,000 people with obesity were in the study here. I didn't even know that Wegovy's real name was semaglutide, which
it is?
All of these names just sound like Star Wars figures at the end of the day. But they said that some of the beneficial effects were seen consistently across measured cardiovascular endpoints with Wegovy here. So additional types of uses for Wegovy, that could be seen by the street as another reason to be bullish on the stock.
You want to take that one, Sean?
Go ahead. I was going to say, I was looking at you.
No, I'm not going to sit here and pretend to be Dr. Saz here. They sell weight loss drugs, and Novo has been really knocking the cover off the ball all year long because of this drug. I continue to look through this through the prism of food stocks. What does this mean to McDonald's? What does it mean to General Mills? And we heard from a lot of companies that have reported earnings the past few weeks, these food companies and snacking companies, even like a PepsiCo, they are concerned about the long-term impact of these type of weight loss drugs. So what are they doing now, guys? They're actually re-engineering their products, putting in healthier ingredients, cutting package sizes. So it's something to watch. And all the stocks have been hammered.
But doesn't that mean that the executives need to get more, perhaps, just display a little bit more ingenuity about how you're going to engage with customers?
Well, how do you redesign a cupcake?
I mean, look, this is going to save 18 million people's lives a year.
That's what. Well, then you'll keep the same price. But that is what they're doing. You're seeing, I think, the big reinvention of big food in large part of these drugs, but you're not seeing it in the earnings results yet. Now, I understand why these stocks have sold off, but by and large, a lot of these food companies have had really strong quarters, and this is really more, I think, concern about the next decade as these weight loss drugs, which aren't cheap, start to proliferate society.
Yeah, and I think that also just points to, you mentioned the fact that it costs a heck of a lot, just what exactly this uptake is going to look like, right? Because when we talk about what the broader impact is, obviously beyond these pharmaceutical companies, potentially when we're talking here about consumer staples, a lot of that depends on how many Americans actually jump in and start taking these types of weight loss drugs. All right, we want to get on to another mover here this morning. We're taking a look at shares of Eli Lilly. It's finding that a single dose of its experimental drug cut the risk factor that signals heart disease by 94%, lasting for nearly a year. Now, this is the first in-human study, the drug reducing a form of a lipoprotein here linked to clogged arteries. More than 1 billion people have genetically high lipoprotein levels here. So this could potentially be a massive catalyst for Eli Lilly down the line here, potentially reducing the risk of heart attacks and for strokes. This was all presented at the American Heart Association meeting over the weekend. So raising that hope that maybe we could see some sort of annual flu-like vaccine shot here that could potentially help protect thousands, millions of Americans.
Eli Lilly shares up 64% year to date. I'm just playing around on the Yahoo finds this new advanced charting tool. It's pretty cool. Big year for them. Ultimately reminds me that I need to go for a checkup soon.
Yeah, absolutely. Also, everyone, stay tuned for Yahoo Finance's special week of coverage, healthcare industry checkup, which Brian Sazza needs to go for. We'll cover all of the top stories in the space starting at 9:30 a.m. this morning. My question is, when you get to that checkup, do you tell them how much coffee you have?
I first have to find a doctor. I haven't really been to a doctor since I was like 30, but we'll take that offline. True story. Anyway, this comes
30?
Yeah, we'll take it offline. You know, we can't want to disclose this information on a global basis. All right, this comes after Emirates and Boeing close a major deal for the airline to buy 90 Boeing 777X jets. The deal is estimated to be worth close to $52 billion. Good news for Boeing. Let's get right over to Akiko Fujita, has more on this one. Kiko.
Good morning to you, Brian. Well, the Dubai Air Show being closely watched as a good gauge for the demand in the airline industry, aviation industry, in the face of global economic slowdown. It's also seen as a good gauge for what travel looks like in the region against the backdrop of that war between Israel and Hamas. That order for those wide-body 777 jets seen as not just a win for Boeing, but also for Emirates, which faces increasing competition in its own backyard. You pointed to those numbers there. Emirates already the largest buyer of those 777 jets. The airline has not confirmed the number of jets ordered, but Reuters and AP reporting the carriers adding 90 new jets to that fleet in a price tag of roughly $52 billion. That is a huge boost in confidence to a Boeing program that has been marred by a lot of delays. We're talking about a delivery now expected in 2025. That is 5 years later than initially scheduled. Its sister airline, we're talking about Emirates' sister airline, Fly Dubai, also expected to announce an order here, adding to the total of its own fleet with 30 Boeing 787 or 787-9 Dreamliners. That is worth $11 billion. You see what the stock is doing there in pre-market, certainly on the back of these big announcements. We should point out this order comes as Emirates faces increasing competition in its own backyard. Turkish Airlines, its largest competitor, also looking to make its own splash with a reported 355 order for Airbus jets as part of an overall 600 fleet buy. That was reported by Turkey's state-run news agency over the weekend. All of these airlines looking to feed travel demand that has seen a big bounce back since the lows of the pandemic. But we should point out this Dubai Air Show coming against the backdrop of this ongoing war between Israel and Hamas with no end in sight. There's certainly going to be concerns about what that does to demand in the region. Bookings to the Middle East have dropped off 26% since October 7th, according to travel firm Forward Keys. But guys, the expectation, at least among aviation analysts right now, is that that drop off is likely going to be short term. But of course, this all depends on how long that conflict extends.
Kiko, while we have you, several kind of press releases that have rolled across for Boeing this morning. Seems like it's already been a pretty successful air show for themselves. Royal Air Maroc, Royal Jordanian. You've also got Fly Dubai ordering 30 Boeing 787s. So a mix of the 787s with the 777 here. You know, what more can we expect for this to be one of the areas perhaps that at least strengthens some of the international business at a time where, yes, you did lay out that there is still this geopolitical conflict and that risk that many CEOs are trying to navigate through?
Yeah, let's put the geopolitical issue aside because there's no way to really sort of gauge how long this extends.
Sure.
Reality is for Boeing, they are looking to really bounce back from those lows in the pandemic, but it's sort of been twofold, as you guys have been reporting out. Boeing having its own issues with its own program. We're not just talking about the 777, but the Dreamliners as well. That has been extended years out. So these orders that have been coming through in the Dubai Air Show, certainly a big boost of confidence. And by the way, this is the second largest air show globally. So that's a big boost of confidence, a big announcement on the part of Boeing being able to rack in some of those orders that have been coming through. Certainly going to be watching over the next few days to see if any other orders come through as well. But as we pointed out, the Boeing stock up more than 4% pre-market. Yeah,
investors trying to price this in as best they can, even if those orders are set to be delivered over years and in some cases decades as well. Akiko, thanks so much for joining us to break this down. Really appreciate it. Everyone, we're also tracking OPEC this morning. They released its monthly oil market report for November this morning, saying that the market's fundamentals remain strong and any weak sentiment is exaggerated. We can see crude futures rising now on the news. Here with more on the sector, we've got our very own Jared Blickery. He's got a new post over there, but the same Wi-Fi interactive. Hey, Jared.
You bet. And wow, just wired directly into the studio here. Let us dig into the numbers. OPEC coming out, they don't like the prices of crude oil right now. It's up about 5 basis points, but their monthly oil report saying that, well, we don't like the prices, so we're going to blame the speculators. That's something that the Saudi Prince, Prince Abdul Aziz, was saying last week. He's head of Aramco and head of their oil strategy. Well, they don't like the excessively negative sentiment, and that's a quote that they're seeing in the market. You can see WTI crude futures are off quite a bit, never really hit 100. And this is WTI, not Brent. Brent got a lot closer after the Gaza incursion, which was actually right here. Now, you compare that to the reaction of Russia invading Ukraine. That was enough to get the prices almost up to $130 per barrel. So we'll have to see what comes of that this week. Also, we get 2 reports from the Department of Energy regarding the weekly oil numbers and stockpile numbers. Here's RBOB gasoline futures. This is a 2-year chart, and they're pretty depressed from the recent highs. You can really see this better on a year-to-date chart in the very lower end of this range right here. I mentioned gasoline futures because we're going to get Walmart earnings later this week. And of course, we get some info on one of the largest sellers of gasoline in the United States. So we're going to be bringing that to you live. And just want to point out, in general, we're seeing futures more green than red in the commodity space. Natural gas up 4%. We are in wintertime, and you can see we are up off of these lows, these $2 lows right here. Nothing in terms of a spike that would give energy consumers who need to heat their homes too much worry. But nevertheless, let's sideline this a little bit and talk about the rest of the sectors in the S&P 500. I'm going to put some pre-market quotes here. All this green that you're seeing in the background, that is from Friday. But we got energy. That is the #1 sector. We were just talking about crude oil prices. That is up 12 basis points to the downside. And most of the sectors are trading to the downside. We have communication services and tech and then real estate. Each of those down about 0.5%. Guys.
All right, Jared, thanks so much for breaking all of that down for us. We'll check back in with you at the opening bell. But keep it right here on Yahoo Finance. We've got all your market action ahead live from our brand new studios. We'll be right back. The holiday season is just around the corner, and retailers are gearing up for the busiest shopping period of the year. Holiday spending is critically important to the U.S. economy and also dominating retailer profits. And while we've been hearing that shoppers are starting to pull back and be a bit more selective with their purchases this year, is that going to be the trend that holds this holiday season? And what does that then tell us about 2024? We want to bring in Ben Laidler. He's eToro, a global markets strategist, breaking all of this down for us. And Ben, we're going to get the CPI print tomorrow morning, and that's going to be the latest reading, obviously, on inflation, maybe a little bit more insight into how the consumer is thinking about these prices. What are you expecting to hear from some of the retailers that are reporting this week, and what that's going to tell us then about the holidays?
I think the consumer's in pretty good shape. I think we're going to hear that from the outlook from the retailers. Clearly not as good as we've seen, over the last 3-6 months, but this is the story that keeps giving. This is why the US isn't in recession. And so this holiday season is the next big test. And I think all indications are that sales are going to be up 3, 4, 5%. That's a slowdown, but it's still a pretty good number. And what stands behind that is a still decent jobs market and wages that are now rising above inflation. So scratch the surface and you can pick holes in that. Consumers are, they're looking for deals. They're trading down a bit, they're sacrificing on other things, but fundamentally, this late in the cycle, it's very reassuring.
Ben, how much of this also continues to lean on the employment situation? I mean, if we look back even to the consumer confidence data, even though it fell again in October, one of the things that continues to be brought up even among the mindset of consumers is where they still have the opportunity to move from one job into another, or if they feel comfortable about their discretionary income right now.
Yeah, it's absolutely crucial. If you don't have the money in your pocket, then you have nothing to spend. And I think it's not only that, but it feeds through into the confidence. Yes, the labour market has been cooling, unemployment's up a little bit, but we're still posting an average 150,000 new jobs. And crucially, inflation has come down enough, and we're going to see it again tomorrow, where I think we're going to come down, pretty decisively to much nearer 3% than 4%. Real wages are decisively rising here, and I think those are key offsets to, the doom crew that think, the consumer's about to capitulate here.
But Ben, this is, not every household is doing well. We have student loan payments coming back. Inflation still remains a lot of problem for households. Why do a large percentage of consumers in this country still feel so depressed about their financial future?
Yeah, absolutely. And don't get me wrong here. There has been a big slowdown. Christmas last year, we grew 7 to 8%. So growth rates have declined significantly. You ask consumers, how many of you are only going to buy if you see a deal? It's getting on for 2/3. The growth rates for online, which is cheaper, are running at twice the growth rates of bricks and mortar. Dollar stores are coming in as the third most popular place to shop. I mean, scratch the surface, and to your point, you see plenty of signs of consumer stress. But again, we're very late cycle here. I don't think we're too far away from the Fed being able to cut interest rates. So we may be sort of running on fumes, but I think the overall consumer remains, fairly resilient.
Ben, so stressed consumers, some households struggling in this country. Do you have a fear of missing out on the rally we have seen in markets the past month?
Well, luckily, we've been in it, and I think that's been the message from the early arrival of Santa Claus over the last couple of weeks. We unwound 2 months of underperformance in basically a week. So I think you've got to be in this market. It's a reminder that you've got to be in this market. But I think the fundamentals are pretty good, and I think they've been good for a while. I think this vice of high bond yields and high oil prices has eased off. That's allowed markets to perform. We've refocused a little bit on the fundamentals. I mean, the earnings recession is over, and I think that earnings story continues to build from here. And we're pushing a little bit on an open door on the technical side. I mean, this is the best seasonality of the year. People are holding too much cash going into 2024, and buybacks have just restarted after earnings season. So I don't find it difficult to make the bull case.
Ben, what's going to lead us higher then?
Well, I think that plus.
Well, in terms of the leadership that we'll likely see in the markets, I guess, where do you see the most strength coming from, at least initially?
So I think for now it's all big tech, right? I think, and it continues to be big tech, just as it's been all year. I think what big tech gives you is it's leading the earnings recovery today. It's those 30-40% earnings, growth numbers versus basically nothing for the rest of the S&P 500. A, and B, we do have most of the slowdown still ahead of us. So people are going to be worrying about earnings. They're going to be worrying about cyclicals. I don't think they're going to be worrying about, the different growth dynamics of big tech and the fortress balance sheets. So initially stay with tech, but I think the more we get into next year, the closer we get to the Fed cutting, the more we move through this sort of soft landing, I think people are going to be looking at the sort of cheaper interest rate sensitives. So real estate, first and foremost, it's the big REIT conference at Nareit this week. This is where people, I think, should be doing the homework on something I think that we could really be looking at again next year. It gets tarred a little bit with the brush of how bad offices are and the structural issues there, but that's only 5% of the REITs market. But also banks, small cap. The further we get into next year, the closer we get to the Fed cutting, I think looking at those sort of bombed out interest rate sensitives and rotate out of the sort of defensive growth, big tech names that we've been in, will probably continue to be in for the next month or two.
Ben, once we get towards, the last 6 weeks of this year, roughly, you're going to start to see low volume that typically takes place. So by when do we need to get to a certain point in the S&P 500 to go against the case for this just being a bear market rally?
Well, so if you just believe the seasonality, that typical Santa rally doesn't come till very, very late in the year. And I think every year it just gets anticipated because everybody knows that everybody else is repositioning into the 2024. I don't think this is a bear market rally. You've definitely had some short covering with people being caught short when this oil market bond yield vice sort of eased off. But we've just had a very strong earnings season. 80% of companies beat. That's a 6-quarter high. The economy, we just came off 5% GDP growth, and we're getting visibility of the Fed beginning to cut next year. And if I'm wrong, that we get a harder landing, I think inflation coming down to closer to 3%, that puts the Fed put back on the table. So that's your insurance policy. I think if I'm wrong, so I think there's a lot to play for next year. And importantly, I think as people begin to look at that, if you're sitting on 5% cash, which is what your average institutional investor is today, I think you're going to put a little bit of that to work as you look ahead to double-digit earnings growth and interest rate cuts next year, and that takes the market up.
Ben Laidler, eToro Global Market Strategist. Ben, great insights and analysis as always. Thanks so much for kicking off the show with us this morning.
Thank you.
Thanks.
All right, what's opening bell on Wall Street? Let's do a quick check here of the markets. We're still seeing some pressure across the board. The Dow just below the flat line, off about 0.1%. Jared Blickery standing by at the big board for a closer look at some of this movement, Jared.
Yes, a little bit of a downbeat to start the week. And let's take a look at the S&P 500. I'm with the prior guest from eToro saying, I don't think this is a bear market rally. We had some negative price action last week off of Powell, but then we reclaimed the 4,400 level. That was a huge level. More apparent on the year-to-date chart. But when the market goes up, in spite of bad news, that is a bull market, and that's what we're seeing right now. So 4,500 probably the next target. We do have seasonality working in favor of the bulls based on this time of year, especially the third year of the presidential cycle. Next year is going to be a different story, so take advantage of it. And while you can here, but let's take a look at this at the sector action. Healthcare, and I'm going to be doing a deep dive into that in the 10 a.m. hour. That is a leading sector. That's up 0.2%, so not a huge amount of movement there. Energy, I was talking about OPEC Plus before the bell. Crude oil just up slightly, and staples, consumer staples is in the green, but most everything here in the red. Real estate down 0.8%, and tech down about 61 basis points there. Let's take a look inside the Nasdaq 100, where we see kind of a sea of red here. Ominous to begin the week. Looks like our ISurge is down about 3.8%. Chinese stock Pinduoduo down 1%. But for the most part, not seeing too many outliers. That would be dark red and dark green. For the most part, we're just seeing some mild selling here. Amazon down 1%. Alphabet, Microsoft each down about 0.5%. Tesla down 0.1%. Let's take a quick year-to-date check in on this chart right here. And after hitting 200, kind of struggling to find its footing there, but it does look like that support level is being respected, at least in the meantime. I was tracking a little bit of weakness in the tech sector, and we're seeing that in semiconductors. NVIDIA notwithstanding, that's up 0.25%. But for the most part, the tech sphere, at least in semiconductors, is in the red. And then another story in software, a couple of green specks here. We got PanW, that's up about 1%, CrowdStrike up 1.6%. But for the most part, tech taking a bit of a back seat today, guys.
All right, we'll see whether or not that holds. Jared, thanks so much. Well, investors are gearing up for what is going to be a very busy week. We've got new data coming out on inflation. We'll also get a look at how retailers are holding up, and even a possible government shutdown could all be weighing on the markets this week. But we want to focus on today's market commentary here. More companies are striking a cautious tone this earnings season over the looming threat of an economic slowdown, causing investors to become more concerned over the weakening outlook for U.S. corporate earnings. But investors, maybe they shouldn't be as worried as they are right now. Yahoo Finance markets reporter Josh Schaefer joining us here at the desk. And Josh, you're taking a look into some of the new research out from Goldman today.
Yeah, and Goldman's sort of highlighting that what we're seeing right now as far as earnings projections is pretty standard to see those forward projections start to fall at the end of the third quarter for 2020 or for Q4 and then going into 2024 too. That's not atypical. David Kostin pointing out that normally earnings projections fall about 4% at this time of year. And so when you think about it from a historical perspective, this isn't completely abnormal. Yes, there are a lot of bad headlines out there. We talk a lot about the macro headwinds, but for it to happen right now isn't necessarily out of the norm. And then I want to take a look at a graph that he highlighted because I thought it was interesting to see where these projections are being kicked down the most. You guys have talked a lot about healthcare this morning. I know you're going to be talking a lot about healthcare this week. Healthcare is still not getting a lot of love in terms of earnings. You see that top purple line there, if you exclude healthcare, would actually be the best. So right now, the street's still not feeling great about healthcare. And of course, your Mag 7 stocks still helping hold up earnings projections.
Yeah, it's really interesting here. I mean, and for the Magnificent Seven stocks, a lot of those companies that have been annexed to the AI conversation that have driven much of the returns that we've seen over the course of this year, from what Goldman is saying around some of their own individual names that they like going into next year or even the end of this year, where are they perhaps highlighting some of those players, and is there a common denominator among them?
Yeah, I mean, so healthcare clearly not one of them, right, as you saw there. And I think overall they seem to feel okay about Magnificent Seven as a whole, because in some ways it feels like most people right now, most of the strategy notes we read, if you feel okay about the market, you kind of have to feel okay about Magnificent Seven to some extent. There aren't a lot of people sort of saying, well, Mag 7's going to fall and then the Russell 2000 is going to come all the way up and small caps are going to be what saves us here. So I think if you're feeling relatively positive overall, yes, you're seeing some common denominator, and at least some of the Mag 7 players will be okay.
Important disclosure here. A lot of these notes, these look-ahead notes, tend to be optimistic. And you mentioning Goldman, I go back to what Michael Wilson is out today with at Morgan Stanley, 7% earnings growth this year, and he's already predicting 14% earnings growth for 2025. So he's skipping over 2024. He says earnings could reaccelerate to double digits in 2025, and that's a tall order. And these estimates are suggesting nothing is going to go wrong with the economy, and inflation will stay down, and maybe oil won't spike to over $100 a barrel. So just very rosy outlooks by Wall Street. I would expect they will continue.
And it's interesting when you point out oil too, right? Because that is one of the main headwind stocks that you find sort of down in these notes, right? With the what could go wrong, it would be
it's a risk,
right?
Upside risk.
Yeah.
But here's our double-digit
risk.
earnings growth estimates,
and the geopolitical risk that we have no idea about, right? But everyone's flagging that's coming out in all these 2024 outlooks. A lot of uncertainty out there still, for sure.
Yeah, one of the top concerns among CEOs, according to KPMG and their survey that they ran earlier this year. Josh, thanks so much for breaking this down for us. Appreciate it. Yahoo Finance's own Josh Schaefer. Let's also take a look at some of today's trending tickers here. Shares of computer and printer giant HP moving higher this morning after Citi upgraded its rating on the stock from neutral to buy. The investment firm also raised its price target to $33 from $31. Citi believes HP continued enhancements in the company's PC ecosystem favorable to its stock and expects potential cost cuts to contribute to the company's rebound in earnings. Saz, you've been hot on this one throughout the morning from the wee hours in the AM here. What kind of catches your attention there?
Oh, just because I got a note at 5:02 a.m. from Citi, and that was exciting. And I just want to tell the whole team that sits behind us right now in the newsroom. No, because HP has really been, shares of HP up 3% year to date. Nasdaq's up 32%. HP has had a challenging year. I think CEO Enrique Lores would acknowledge that. The PC slowdown impacted the first half of the year performance. They've had to work through that glut. But this is a company that I think Citi is reminding investors has taking out billions of dollars in excess costs from their business. And then the other catalyst, which not only applies to HP guys, is this upgrade cycle potential for PCs as AI gets layered on top of it. Now, I asked about the potential or the impact from AI PCs to Intel CEO Pat Gelsinger recently. Take a listen to what he said.
Major milestones that we hit operationally, key roadmap milestones in PC, the AI PC, the server progress, our AI product lines, but maybe most importantly, the process technology, our 5 nodes in 4 years, just hitting major milestones on that audacious plan that we laid out.
So Pat talking about some of the technology he's rolling out to support this next or this upgrade cycle with AI PCs, but again, an interesting upgrade over by Citi, I would say a little bit ahead of the curve with that upgrade. Also watching Exxon, Sean.
Yeah, certainly. Let's talk about Exxon here because it's another big name that we have our eyes on here this morning. The oil giant has set its sights on dominating the EV lithium market. The company saying it will start producing battery-grade lithium at its Arkansas drilling site, and by 2030, aiming to meet the manufacturing needs of more than 1 million EVs annually. The U.S. is currently heavily reliant on imports from South America to meet its lithium needs. And guys, we've been talking about this time and time again, just the shortage and what is available here. When we talk about the migration, the mass adoption that we are eventually expecting when it comes to EVs, it seems like a long way out. We have seen a lot of these automakers delay some of their plans in terms of EV production here by a couple of years. But certainly, this is a step here, at least in the right direction, securing some more lithium, obviously, and very much needed.
It's tough to recall an earnings call this year that Elon Musk has not talked about lithium mining need and how critical that is for clean energy, as well as just making sure that his company Tesla can sell electric vehicles in the future too. So it certainly helps him out. But in some of the key call outs here for what this energy transition is going to look like, the first production is targeted for 2027. The domestic sourcing, that's going to contribute to energy security. ExxonMobil is saying here, supporting manufacturing and advancing some of the U.S. climate policy initiatives. And then additionally here, this is attempted and expected to unlock vast amounts and supplies of lithium in North America. So ExxonMobil coming out this morning, finally meeting the call that Elon Musk put out months ago, saying, hey, we need people to make sure that they are mining for more lithium, making sure that they're bringing that into the landscape. And ExxonMobil responding this morning with a, we got you, brother.
Good call by Exxon CEO Darren Woods with this initiative, just at a time where EV prices are falling and people are saying they don't necessarily want EVs. So Darren Woods clearly hitting a home run.
All right, Brian, thanks for hanging out with us this morning. Who won the mug? Because I know I was first to tweet.
I'm glad you updated, because I did not actually predict the responses on Twitter for this mug. So we don't have a lot of these mugs, guys.
Show them the other side of the mug, too.
My mom is actually watching. Hi, Mom, our new studio. Thank you for your support. You did not come in first, so you can't actually get a mug. So
wow.
I'm sorry. You came in about 5th place on the mug. So I can't, I'm
Did you
sorry.
say who was first place?
It wasn't my mom, so she's not getting a mug. I'm
Who
sorry.
tweeted at 903? It was this guy.
Yeah, it actually
You already
was.
have one.
She already got a mug.
Well, look.
Let Sazzy's mom have one.
People need 2 mugs
She,
sometimes.
even if you did, she still can't get one.
Here's the thing. I would sign it, and then we would all sign it and send it to her. How about that?
Oh, that's kind of nice.
That's
Oh,
nice.
come on, really? You got to do that
Christmas
now?
gift.
God.
We got you.
There you go.
Got
Save
you
you a
covered
little
here.
bit of money, too.
All right, fine. Okay, fine.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance Live. Keep tweeting at us for some more mugs.
Few words are as emotive in American discourse today as healthcare. It's an industry and a system that both insiders and patients agree is broken. From affordability and access to the government's drug pricing negotiations, the challenges are endless. Meanwhile, big box and digital health are pressuring traditional systems. Companies like Amazon and Walmart are thinking about how to get you to think about healthcare while you're shopping. Then there's the excitement and apprehension around AI and what its role is in healthcare. And of course, the buzz surrounding the newest weight loss and diabetes drugs and what it means for other industries. We'll tackle all this and more in a special series starting November 13th, only on Yahoo Finance.
The healthcare industry has seen big changes since 2020 when COVID-19 took over the world. Well, between the rise in telehealth, big box retailer partnerships, and increased competition, we're bringing you all of this and more in Yahoo Finance's Healthcare Week. Yahoo Finance's Anjali Khemlani, who's leading the charge, leading the coverage on this, joins us now in studio. And Anj, certainly a very busy week when we talk about not only the changes that have taken place within this industry over the last couple of years, but also what the future holds and some of those changes that are on the horizon.
That's right. And of course, as you mentioned, part of it driven by the pandemic, and some of it has actually started before. So, when we talk about all of the big things that we've been thinking about, and you covered some of it this morning with the GLP-1s, those weight loss drugs, that's only part of the conversation. And so one of the things to keep in mind is we saw that transformational change when there weren't the facilities that people could go to during the pandemic. And so we found alternative options. We found telehealth, we found retail health, minute clinics and the like were really starting to take over, especially when you talk about delivery of vaccines. So all of that has played a role in how we think differently about healthcare today. And then you have entrants like Amazon. We know that they have been pursuing that healthcare realm for years and now are finally making some breakthroughs. So I did previously speak to the SVP of Amazon Health Services about their role in disrupting this space. And here's what Neil Lindsay had to say.
What are the experiences that need to be improved that we can make a difference in? And what we're good at is connecting the dots between people as customers and humans to the products and services they need. You do that in a general sense. And in healthcare, the need is the same, right? We need to connect the dots.
So connecting the dots, and that's really what a lot of other companies are taking a look at. How do they become part of the conversation? How do they then connect the dots from the insurance side to the provider side to the medication side and prescription side? So all of these parts have really stayed within silos for years, and there are companies that are trying to wrap their arms around all of it. I also spoke to Noom, the telehealth, digital health company, about this GLP-1 craze. They've been a little bit slower to start off as well, and they are looking at a really, a concentrated tactic, and that's something you'll also start to see more when it comes to digital health. Who's rushing in and who's taking a step back and deciding what is a more strategic way of getting into the space. So listen to what Jeff Cook had to say about that.
The studies for medication removal, absent behavior change, are quite clear that you get kind of instant, more or less, very quick weight gain on removal. And so, but paired with behavior change, I think that's where the amazing results are. And so, we're super excited to see the med as basically a way to kickstart, to your point, but to kind of continue that momentum with the behavior change so you can come off it. I think most people do not want to be on a GLP-1 for the rest of their lives.
Nor do they tend to be. We know that people do jump off the drug in about a year. So all of this is what we're going to be covering and more this week.
All right, very exciting stuff there. Anjali Khemlani going to be having a host of conversations, range of topics going to be dove into. We're going to cover it all. All right, Anjali, thanks so much. Appreciate it. Everyone, we're also tracking this news here this morning. Private equity group General Atlantic has reached a deal to acquire a majority stake in Joe and the Juice. The deal will value the food and beverage chain at about $641 million. Yahoo Finance's Brooke DePalma joins us with the details here. Brooke, what do we know?
Good morning. Well, General Atlantic was actually already a minority shareholder. Now they reportedly agreed to buy that stake held by another private equity firm, bringing them to that majority stakeholder. Now this will increase General Atlantic's stake from 30% to somewhere between the range of 80 to 90%. And with this, Joe and the Juice will have the ability to, what they say, retire its debt and fuel growth. Now the company has been expanding rapidly in recent years. They plan to expand internationally even more so. They currently have about 360 stores globally. They also plan to grow digital sales. Right now, digital sales make up 30% of global sales. They see potential to increase that to at least 50%. It came to the U.S. market about 7 years ago, but it was founded in 2002. And Joe and the Juice has really been evolving into what they say is what they want to be, rather, a lifestyle brand. And if you take a look at General Atlantic's portfolio, they do include other brands that have this sort of lifestyle type of feel. Think a Gym Pass, a Shein, StockX, Vox Media, BuzzFeed, Tory Burch, as well as European Wax Center. And in addition to that, it's important to note that as the U.S. consumer specifically continues to be very close to digital ordering, they continue to evolve the way they order. This is a market that they're looking very close at. They reportedly were going to look to go into to IPO a few years ago, but they decided to back down pre-pandemic. And so lots of growth, lots of momentum for this company, and definitely one to look out for.
Yeah, and I can speak personally that a lot of their users or customers are very loyal customer base as well. Once you go in there, it's hard not to go back.
Yeah, that's what they want.
Extremely good.
Right.
So it makes a lot of sense. All right, Brooke, we are twinning today on the first day of our brand new studios. But Brooke Obama, thanks so much for breaking all of that down. Keep right here on Yahoo Finance. We've got all your market action ahead. We will be right back. Our vibe on the street today, a tale of two Fed forecasts. Morgan Stanley economists are expecting deep cuts over the next 2 years, with the Fed funds rate hitting just about 2.3% by the end of 2025. But it's a different story from economists over at Goldman Sachs, who are predicting the first rate cut in Q4 of 2024, followed by one every quarter through mid-2026, leaving rates between 4% and 4.25% by the end of 2025. So certainly we're seeing, in terms of the predictions here from Morgan Stanley, a much more aggressive path forward. They see, at least, for the Fed to cut, when they do expect the Fed to start cutting here in June of 2024. So they essentially see cutting in June, again in September, and every meeting from the fourth quarter onwards in the 25 basis point increments. They still, though, in that scenario, think the U.S. economy is going to be able to avoid a recession. They still think a soft landing is possible, but that fear of recession is going to be real, and something that we are talking about when you couple that with the weakening growth or weaker growth that Morgan Stanley is expecting. Goldman Sachs, though, a little bit more in line or similar to what we heard from the Fed and the Fed's projections for rate cuts.
And it just continues to put in eyesight how much work we still have to get to do to get down to some of the Fed's targets there, and where unemployment might tick up too, because in the longer term goal, the longer run goal of getting inflation down to 2%, you could see the unemployment rate get up to 4% here. And one of the things that we've watched in this month over month move here is that we did see a tick higher in the unemployment rate. Even if we do see continued jobs being added here, it came in just a little bit below expectations. The markets reacted positively to that largely. But at the end of the day, even as you're looking across the different projections coming in from both Morgan Stanley and Goldman Sachs, it still is going up against the Federal Reserve board members and Federal Reserve Bank presidents, who are anticipating that when we get into 2025, that's when we'll finally get down towards that 2% without actually getting to 2%. So will the Fed be comfortable with a two handle on inflation rate, excuse me? Will they be comfortable with that two handle in order to begin cutting at some point in 2024? Midpoint through 2024 is where some of those economists are predicting that we may see a cut come through.
Yeah, certainly. As we also take a look at some of the outlooks here from the equity side of things, certainly the tone very optimistic here as we head into the final weeks of the year. But you mentioned the fact that there's so much uncertainty out there on the street still. Lots of questions just about what exactly 2024 is going to look like, obviously from a market perspective, but also from an economic standpoint as well. We'll keep right here on Yahoo Finance. We've got all your market action ahead. We'll be right back.
Amazon's robotic future is unfolding inside a top-secret warehouse facility, codename Boss 33. The robots in development here could one day solve some of the biggest challenges facing e-commerce by driving efficiencies and improving safety. While many of its competitors are investing in robotics-based fulfillment centers, Amazon, with its army of 750,000, is designing, building, and deploying its own robot workforce, driving profits and market share for Amazon more than its human-dependent rivals.
I'm Allie Garfinkel, and this is what's next for Amazon. We are standing outside this unmarked building that hosts some of the most advanced autonomous robots in the world. It's so secret that if you were driving by, you would really have no idea. And most people who work at Amazon don't even know where this place is.
If you're investing in Amazon, robots are what Amazon's investing in, according to industry analysts and company representatives. Analysts say that Amazon's goal is to substantially boost margins in its most consumer-facing business, retail. And here at this simulated distribution center, robots are learning how to work alongside humans. This is Proteus, Amazon's first fully autonomous warehouse robot. It may look like a Roomba, but Proteus signals where the robotics revolution is headed, towards robots that are increasingly self-sufficient.
Proteus has 8 different sensors, 5 different cameras, and they're for navigation. The primary LiDAR sensor for Proteus is right here. See, it's actually giving me the red light. Its eyes are getting bigger because I got closer, it stopped. And the most special thing about Proteus is that it's autonomous. This is a robot that can move around completely on its own.
Unlike most warehouse robots, Proteus is designed to interact with people. Proteus's sensors can distinguish between humans and other robots, and its eyes are programmed to be expressive. The goal? For human workers to feel safe with robots and to be able to understand the robot's needs so the two can work together effectively.
What they're trying to do, in my opinion, is lean into automation over time to potentially increase the efficiency of their large fulfillment center network, enabling them to get more products to consumers on a 1 or 2 day basis in as cost-efficient manner as possible.
For Amazon, the financial stakes are high. Consider this. During the pandemic, Amazon hired 327,300 people over the course of 2020. By the end of the year, more than 1 million people were working for Amazon. But about 2 years later, under macroeconomic pressures like inflation and rising interest rates, the company began cutting its workforce, laying off 27,000 corporate employees over several months. And investors felt the strain. Over the course of 2022, Amazon lost nearly half its value in what was the stock's second worst year ever. Over time, Amazon's increasingly robotic workforce could smooth out booms and busts for both Amazon and its shareholders. It's a long-term investment that began more than a decade ago and still hasn't reached its full potential. While founder Jeff Bezos was personally investing in robotics companies as early as 2008,
why am I feeling so much like Sigourney Weaver?
Amazon made its first big move in 2012, acquiring industrial robot maker Kiva Systems for $775 million. Today, that facility is known as Amazon Robotics. The robots that you see here are still in development. With these models, Amazon says it's working to solve 2 of the biggest problems in robotics: manipulation and gripping. One of the most advanced is the AI-driven Cardinal, a towering robotic arm that can identify packages and lift up to 50 pounds. Cardinal will one day operate inside Amazon's shipping docks, the final stop for billions of packages a year. More boxes out the door faster, potentially leading to increased profits.
For the first time, this robot will be almost playing Tetris with the packages. So we get a super dense shipping container. That's going to make our trailers more efficient and actually increase speed to our customers.
Though Amazon has been very open about its commitment to robotics, the company declined to disclose how much it annually spends developing and deploying robots. And analysts Yahoo Finance spoke with also couldn't put a price tag on it. Company watchers suggest that Amazon's robotics investment is hidden away in financial statements under categories like CapEx or technology and content, which Amazon spent over $40 billion on last year. Here's what we do know. Amazon is the place where you buy pillows and coffee filters that are delivered, increasingly with the help of robots, to you in 2 days or less. It's where you watch original shows, movies, and live sports. It's cloud computing in Whole Foods, medical appointments, and gaming on Twitch. The market values Amazon at $1.3 trillion, and in 2022, the company generated $514 billion in revenue. When it comes to U.S. online shopping, they're the leaders by a huge margin. Amazon has a grip on 37% of the e-commerce marketplace. Walmart, their closest competitor, comes in at 6.3%.
We're in Madison, Illinois, at one of the largest Amazon warehouses in Chicago. It's also the site of some of the most advanced robotics in the world.
The robots here are tied directly to Amazon's bottom line today and to its future, as the company looks to make deliveries faster and cheaper. Over the past 10 years, Amazon has completely upended the shopping experience for consumers in what is now called the Amazon effect.
Most companies still cannot deliver Amazon's promise. Very few are capable of getting same-day, one-day, two-day delivery. It is a differentiator. You see most e-commerce companies now, instead of really trying to compete, they're just trying to give transparency.
I put the issue of delivery time in robotics to the head of Amazon's fulfillment centers, Stefano Perego.
Is two-day delivery possible at scale? Is one-day delivery possible at scale without robotics and AI?
I think it would be very difficult to do faster deliveries, like a regionalization process without leveraging AI for optimized placement. So on large-scale network, it's very important to leverage technology, whether it is robotics or AI, to make sure that we serve the customer with lower cost and faster.
Consumers want speed. Wall Street wants efficiency.
Robotics is playing a vital part to our strategies. Robots and AI are critical to that process because you take away cost to serve by leveraging robots, and you are taking away time by making faster deliveries to customers by leveraging a robot. In that sense, AI and robotics help us to make our own future.
If you want to drive margins higher, you need to keep costs down. A robot can effectively work 24/7, relatively fixed costs. But if you can do more volume using robots, they could drive more revenue on the same costs. That would generate more profits.
According to the American Staffing Association, 74% of Americans believe increased automation will take jobs away from humans. In February of 2023, ARK Invest CEO Cathie Wood, a longtime Amazon shareholder, said that by the year 2030, the company could have more robots than employees. Amazon says more robots in its warehouses won't take jobs, that it will create them, as more and more people will be needed to work with and repair the technology. The changes that Amazon Robotics promises are still in the making, as Amazon works to stay ahead of the competition with faster delivery times. But customers and investors will ultimately be the ones to decide if Amazon's robotics bet has paid off.
I'm Madison Mills alongside Yahoo Finance senior reporter Ali Garfinkel. Ali, you know I love this piece, and you got to spend a lot of time with robots here. In the piece, you talked about CapEx. How did your reporting on this inform how you're thinking about the ROI on robotics investments?
Maddie, good morning. It is great to see you. You know, my takeaway here, Maddie, goes beyond Amazon. This reporting has really changed how I think about robotics investments across the market. I've actually become more broadly skeptical of these robotics investments, and here's why. Robotics is capital intensive, it's iterative, it's complicated. These are long processes. If reporting on Amazon has shown me anything, it's that this robotics can really take a long time to get right. Just because you start investing in robotics today doesn't mean you're going to see the ROI next year, the year after, or even maybe in 10 years at its full potential. The reality is this. We can't yet produce robots en masse the way we do with cars. And I do believe that day will come. But until then, I think investors should actually be thinking about robotics with a little bit of a healthy dose of skepticism. Robots are absolutely valuable, but they are not a quick fix.
Ali, we're going to talk about that skepticism exactly and more with our panel here. We've got more on how to invest in robotics. So we're going to bring in Ray Wong. He's the principal analyst and founder of Constellation Research. We also have Jason Del Rey here. He's a tech business journalist. He's also the author of Winner Sells All, Amazon, Walmart, and the Battle for Our Wallets. Great to have you both on. And Jason, I want to start with you. As the name of your book suggests, you know these big names very well. So I want to get a sense of the impact robotics investment could have on a name like Amazon in the next 5 years. How much do you anticipate robotics coming up in Amazon earnings calls? Is it going to get a mention, or could it be the headline?
I think it'll be mentioned more often, but I think it's very important to recognize that in the last decade, I think we were looking for this Amazon robotics advancement to happen even faster than it has. I think the media, and maybe even some inside Amazon, thought that maybe by now there'd be many fewer workers, and it's a long, hard problem to solve. They're trying to solve different problems, to replicate the human hand in picking and packing of all these items, different shapes and sizes. They're on their way, but I would just say, they seem to be ahead of the pack among e-commerce players, but they still have a long road ahead as well.
And Ray, if you had to put a percentage on it, how much do you expect Amazon's margins to improve in its retail business over time due to these robotics?
No, it's a great question. And Jason's right. It's going to take some time, but we're talking about the ability to take these margins from 14.5% to the high 30s in the future. And that's coming from labor savings. That's coming from the fact that you have less errors. That's also coming from the fact that you got faster, better, and cheaper all in one opportunity.
Now, Jason, there are a lot of numbers that we don't know, but there is one that we do, and that's 1.7 billion. That's the amount that Amazon is looking to spend to buy Roomba. Now, what is your sense of the depth of Amazon's ambition in robotics? Is it to make its way all the way into our homes?
Yeah, so my opinion on that acquisition is that it has just a lot to do with Amazon's intent and play to own as much gadgetry and robotics around the home. So everything from Alexa to their Ring acquisition years ago to the Blink security acquisition, and now Roomba. So I see it in sort of that same play, in your home. Yes, you may be on your phone, but you're interacting with all sorts of technology and automation, and they want to be the number one player there. Is there a chance some of the technology from that acquisition could help robotics and automation in other parts of Amazon? Perhaps, but I don't think that's the main play here for Amazon.
Well, Jason, I know you know that space so well, but Ray, I want to bring you in on Amazon's overall strategy to improve margins, because robotics is just one small slice of that pie. What else can you tell us about Amazon's overall strategy to bump up returns?
Yeah, if you think about what's going on here, I mean, there's a labor cost that's driving everything. And so anything from autonomous vehicles, anything to be able to do pick, pack, and ship. Really what you're trying to do is figure out how to solve the supply chain and logistics aspect. And the more you put automation, the more you pull AI in place, it allows you to go from human scale to machine scale. And that's really why it's so important to be able to actually think about, every process, every opportunity for automation. And of course, it does take a lot of time, like Ali was saying, because to get from 80% to 90%, that's just as hard as it's to get from 90% to 95%. And each of those incremental improvements, just as a result of time and iteration. The other piece that's actually you're seeing is that's just the back end of the operations. The front end of the operations are coming from AI and getting better understanding of what customers want. And so if you get the demand and the supply together and you shape that properly, you can actually improve margins, you can reduce the number of returns, and you can actually get better at pricing.
So Amazon obviously isn't the only company that has access to the tools that you're talking about. Jason, I think a lot about a company like Walmart heading into earnings this week, the biggest grocer in the country. To what extent could Walmart leverage robotics either through innovation or acquisitions like we've seen to compete with an Amazon?
Yeah, I think the important thing for a company like Walmart is to use robotics, to increase the advantage that they may already have over more pure play e-commerce players like Amazon. And that's really the immediacy of their stores, the ability to order and pick up the same day or have delivery from stores the same day. And so they bought a company called Alert Innovation. They have a system called Alphabot that is a retrieval and a storage and retrieval system that is built onto the side of a store to help workers more quickly pick and pack orders that can be either picked up or delivered that very same day. And so this is a huge opportunity for them. They need to invest heavily, but yet, they don't have the margins of an AWS helping them. They're starting to build an advertising business that has great margin, but it's much smaller than Amazon. So it'll be interesting to see how aggressively they can spend to ramp up. They have a long way to go.
Now, Ray, robotics won't just impact company-to-company competition. You're expecting it to impact geopolitical competition. How might robotics transform the US-China dynamic moving forward?
Oh, it's a big factor, right? I mean, if you think about China, their population dynamics are shrinking over time. They need robots to be able to keep up. They're going to look like Japan in 20 years in terms of their age demographic. And you're going to see a lot more of that automation that's going to come into place. In the US, at least, we still have immigration and a good supply of labor, even though it's been very, very tight. And in terms of competition, we actually have to be able to catch up from anything from automating the way ports operate to automating what actually happens in the last mile in terms of the distribution, in terms of transportation management, and warehouse management. Those are coming into play. And I think that's really the big competition is really our ability to actually move more goods more quickly and be able to do it at lower costs and be able to take advantage of more cycles that are being offered when we get to automation, because automation allows you to get to 24/7. The robots play a key role in doing that. And whoever can actually compete more quickly to be able to do that is going to win in the geopolitical wars.
So Ray, I want to stick with you here for our audience of investors listening. What would you say are the publicly traded robotics companies that investors need to be looking out for?
Yeah, there's three that I look at, and I think ABB is one there. They've been leading in this space for quite some time. FANUC is another one where you're actually seeing a lot of automation, not just in warehouses, but also in manufacturing, and also SMC Corp. These three companies are leading in the space, but more importantly, these are publicly traded companies. There's also a number of companies that are not publicly traded that are actually have a lot of innovations in that marketplace.
A lot of developments there to watch. Thank you so much for joining us. We had Ray Wan and Jason Del Rey, and of course, a huge thanks to our own Ali Garfinkel. All your markets action coming up ahead, so stay tuned. You're watching Yahoo Finance.
Few words are as emotive in American discourse today as healthcare. It's an industry and a system that both insiders and patients agree is broken. From affordability and access to the government's drug pricing negotiations, the challenges are endless. Meanwhile, big box and digital health are pressuring traditional systems. Companies like Amazon and Walmart are thinking about how to get you to think about healthcare while you're shopping. Then there's the excitement and apprehension around AI and what its role is in healthcare. And of course, the buzz surrounding the newest weight loss and diabetes drugs and what it means for other industries. We'll tackle all this and more in a special series starting November 13th, only on Yahoo Finance.
Well, healthcare stocks certainly have been in focus over 2022 and 2023, but it's been a different story in 2023. They've underperformed the broader market, but with all the hype around the sector, doesn't that seem strange? Has big tech and the growth of AI stolen the limelight? As Yahoo Finance's Healthcare Week ramps up, Jared Blickery gives us the context that we need. Jared?
Brad, it's as simple as this. Last year, we were in a bear market. This year, we're in a bull market. Healthcare, especially with some of the bigger names, typically a defensive class of stocks. So not surprisingly, they are the third worst this year behind real estate and utilities and just ahead of staples, all of those defensive. Now, it's not always defensive when you consider all the names in the sphere. It's mainly the large cap ones, but we do have some growth stories this year. This is what's happening today, kind of a sea of red. But if you take a look at the year to date, you can see Eli Lilly and Novo up 60% and 46% respectively. These are incredible growth stories, of course, around the diabetes treatment and GLP-1 drugs that have been based off of them. But for the most part, we're seeing a lot of red elsewhere. Last year, it was a different story. But let me just show you what's happened in the healthcare sector over the last 2 years. This is the XLV Spider Fund. This covers large cap healthcare, and you can see it's a bunch of sideways action here going back to 2 years ago. However, I want to show you another chart. If you take the performance of the healthcare industry and you divide it by the S&P 500, its benchmark, you actually see on a relative basis, we are at the lowest prices going back to the beginning of 2022. So that's almost 2 years. So suffice to say, healthcare has been really underperforming the market. But not for everything. As I said, Eli Lilly up 60%, Novo up 46%. I was taking a look at some of the top stocks in the S&P 500. This is everything that's up 50% or more or thereabouts. You see Alphabet right at the threshold down here. If I sort by performance, you can really get a feel of what has been hot this year. NVIDIA, the AI story at the forefront, that's up 234%. Meta, also AI. Royal Caribbean, well, that's another industry, consumer discretionary up 93%. But where does Lilly fit in? Right there, up satisfying 61%. But that is the only healthcare stock among these winners here. So suffice to say, healthcare has taken a little bit of a backseat this year, but we definitely have some outperformers.
Thanks so much, Jared. Well, we're definitely kicking off an interesting week for Healthcare Week. Few industries have experienced the rate of change that healthcare has undergone since the COVID pandemic, from the rise of telehealth to mRNA vaccines, increased competition from big box retailers, and now, of course, the weight loss drug boom. Much has changed since 2020, but is the way we look at our healthcare really that different? Joining me for more and a look at that, our first guest for Yahoo Finance's Healthcare Week, Sachin Jain, CEO of Scan Health and Health Group. Thank you so much for joining me today.
Honored to be here. Happy Diwali.
Happy Diwali to you too. So let's talk about that. Is it really different? We know that so much has changed since the pandemic. We were forced to find healthcare outside of hospitals when they were locked up with patients. We saw the rise of pharmacy and retail health, as well as telehealth, really play a role. I know you're in charge of a payer, but you do have some thoughts about this. So tell me about what you think has changed permanently in the way we view healthcare.
Well, for one thing, I think we no longer think of facilities as being at the center of people's healthcare experience. But I do think one thing that people are starting to think about is really the soul of healthcare. And what I mean by that is, I think these large institutions that people typically relied on for care were local, and people felt like they had a real relationship with them. Today, people are increasingly seeing care, accessing care through virtual means, as well as through other channels. And I think people are wondering, where is that relationship going to come from? And I think it's a big challenge for the industry, which is that many people expect a strong relationship. And some of what the digital health and telehealth revolution has done has switched healthcare into a series of transactions as opposed to a relationship-oriented field.
I'm glad you said that. Transactions is the key, because we know there's also the rise of cash pay options and the like. And all of this while the traditional system is a little bit under pressure. We know that, for example, hospital systems, other facilities and industries, sectors in the industry are looking at making ends meet. You had an interesting thought recently on layoffs, saying specifically a specific savings target becomes a blind fixation that overtakes even a passing analysis of the staffing levels to meet even basic service levels. And to translate that into normal terms, layman terms here, it's basically that there are so many endpoints that these facilities have to meet, whether it is revenue or staffing levels, and it comes at the detriment of care.
Look, most physicians I talk to believe that we have a crisis in the management of healthcare organizations. And that crisis really comes from the application of MBA toolkits to healthcare delivery settings. And what I mean by that is when you're trained as an MBA or a finance person, you are really trained to think about things in terms of targets and hitting those targets. And sometimes there are things that are more important than targets, like patients, like people, like the workforce, like staff morale, that have a critical effect on the output, which is the clinical care that's actually delivered. And I think sometimes the excessive focus on targets leads us away from actually delivering the kinds of outcomes and building the kinds of relationships that we were talking about before. And so you do see health systems that are laying off people, not necessarily thinking about whether or not they have adequate staffing to actually serve the patients that they're serving in order to meet their financial targets. Now, many people say things like no margin, no mission. At the same time, there is just meeting the basics of actually taking care of the people that you're taking care of and being in the business that you're in. And so if you're not able to necessarily restructure your organizations or restructure your care processes to lower costs, and your only blunt instrument is a layoff, you end up in this funny situation where people in some of the best academic health centers in the world or the best health systems in the world are saying that they don't necessarily have what they need to actually take care of patients. You have labor strife, you've got strikes, you've got increasing regulatory and reimbursement pressure. This is a very tough time to be in healthcare. At the same time, the thing we can't lose sight of is our focus on patients and focus on doing what's right for the people that we're trying to serve.
And on that note, you have put your money where your mouth is a little bit in that respect with your efforts with homeless care, as well as creating a formulary for patients to access care, drugs at a lower cost. So talk to me about setting all that up. These efforts that you're doing, is it something that can be replicated at scale, or is it only population specific to where you are?
Look, the homeless efforts that we launched really came from acknowledging the fact that we have an epidemic in plain sight. You go to many major metropolitan areas in this country, and you see that, besides incredible riches, we have people who are struggling with mental illness, struggling with addiction, living on the streets. And what has been cast in many settings as a housing issue is really a healthcare issue. And so we as Scan Group have made an investment in a new medical group called Healthcare in Action that is part of the Scan Group that ultimately serves people on the streets, that ultimately tries to address the needs of patients who otherwise wouldn't have access to care and services. And we measure ourselves one way. It's whether people get housed or not. And we're pleased that more than 100 people have actually been housed through our Healthcare in Action program that started just a couple of years ago. The other thing that you referenced was our new formulary, which is associated with our Medicare Advantage plans. And what we are doing is offering some very common drugs, the drugs that we would want for our mom and dad, at zero copay. These are branded drugs, and this is in line with some of the regulatory changes associated with the IRA that have been introduced, wherein these drugs are going to be available to people for lower costs, and the government is negotiating them. We're introducing a zero copay or $11 copay formulary 2 years in advance of the IRA negotiations, because we wanted patients to actually get access to these drugs. You asked whether it's replicable. I think it is replicable. I think we have to move away from gimmicky healthcare to actually delivering healthcare and serving people the way that they need. Whether you're a for-profit or not-for-profit, we happen to be a not-for-profit. At the end of the day, we have to try to serve people the way that we want them to be served. And we, I think, have gotten away from that in our industry.
Yeah, it seems like it's a lot easier to negotiate drug prices these days. Should we just be doing it ourselves?
Very easy. You and I should just go and negotiate. Yeah, so let's call Eli Lilly today.
Let's do it. Well, thank you to Sachin Jain, CEO of Scan Group and Scan Health Plan. Thank you for joining us today.
Great to be with you.
Don't go away. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Data, data, data. As markets attempt to anticipate the Federal Reserve's final rate decision of 2023, Chair Powell hinted last week that any decision will ultimately depend on data. The October CPI due tomorrow morning, the first in a heavy slate of U.S. indicators, providing a glimpse into the U.S. economy's performance here and much needed clarity about the state of the Fed's inflation fight. So what does a closer look at October's data thus far tell us about the state of the economy, and what can we expect going forward? For all those questions and much more, we've got joining us in studio, Lakshman Achuthan, who is the co-founder of the Economic Cycle Research Institute. Great to have you here in studio with us. First and foremost, as we think about what is next to come, and even as we've heard more economists from some of the largest banks here in the U.S. spell out what they're looking for in 2024, 2025, as far out as then, even we still have the here and now of the Fed's decision to come at their next meeting.
Yep. My gosh, I just laughed. I'm sorry when you said 2025, because who knows?
Exactly.
Right? I mean, it's hard to know what's happening in the next month, as you say. So looking at and we all are just trying to look at the latest data and analyze it in some sort of framework to say, what do I expect? Should I lean this way or lean that way?
Does it feel like they're leaning too much into data at this point? That is rear view mirror. That's backwards.
Yeah, well, they have to, right? So there's a lot of monitoring going on, right? So it's a good point what you're making. That's backward-looking coincident data, a lot of nowcasting. So you can have, I just looked, all these credit cards were swiped, so I know what's happening. Well, actually, you know what just happened, right? And to your point. So to do forward-looking, you need some sort of framework. And there'll be big econometric models that'll say, well, if you push this, then that should happen. Or if I survey you and you say something, maybe you'll actually do it. I don't know. All of these things we're trying to figure out. So from our vantage point, when cycles, what we're looking there are just patterns. There's free markets have upswings and downswings. They're messy. They do not act the way you expect them to act. Sometimes they go a lot further because we get really excited and we get really upset. And we do both of those things. I mean, we, the collective we. And so here we are. I'm pretty darn sure we're in a cyclical slowdown, okay? As best as I could tell, looking at backward data, current or forward-looking data, it's still continuing. And the Fed, separate from growth, which is slowing, which is what they want, right, is concerned about inflation, right? So what's going on there? That is also cyclical. And that is slowing, and the market is saying, okay, we've done it, right? The slowing is good, we're good to go. It should be kind of clear skies pretty soon once we get over this little valley here. And the forward-looking data on inflation is saying, well, directionally, sure, it is slowing, but are you gonna get to where you wanna go quickly? Well, that could take a while. And that's the higher for longer that we've been having this back and forth discussion on. To your question just now, sorry, it was a long answer, but the thing is probably still a little more higher for longer.
So higher for longer. Then when we talk about the inflation fight right now, just putting a little bit more of a timetable on this, when we're talking about if the Fed is able to get it back to their 2% target,
right.
Should they still be targeting 2%? Do you think that's fair in this economy, given some of the changes?
Yeah, so they've got to they have these mandates, right? Yeah. Jobs growth and stable inflation. And for whether or not the actual number 2 is a real number or whatever it is, the intention is clear to get back down there. You saw expectations. We surveyed a bunch of people at the end of last week, and they were like, whoa, we see a lot of inflation in front of us, especially like 5 to 10 years, which nobody can forecast, but it's more about how you're feeling, and they're feeling that way. Right. That's got to put the Fed on edge. I think rather than letting the base of inflation drift up, as an institution, their credibility is all around inflation stability. So I think they're going to stick with it. And he's been saying that. They've all been saying we want stability.
Can they do that and avoid a recession?
Oh. It's hard to have your cake and eat it too, right? And it's supply and demand. The one cure for high prices is high prices. We're seeing that. Demand is going down. If you're going to get to 2%, let's just to pick a number. So let's say we're north of 3 somewhere, and you want to cut it in half. There's going to have to be some come down in demand growth, and it's hard to have your cake and eat it too. So the risk there is still, I think, of generally to the downside, especially globally. You see the same kind of dilemma in Europe and elsewhere. So there is some general brakes being put on. It'll be very interesting to see, I think month to month, energy prices came down, so CPI will come down.
Right.
That'll happen.
If we do get even a 2 handle on CPI at some point, because the target is 2%, getting inflation down to 2% for the Fed, does a 2 handle alone justify a cut next year?
If you had it on a sustained basis, right? You can't. One data point doesn't really matter.
We can't just start cheering once we see that 2
I mean,
handle.
you will.
Okay.
You will. We will. That's our nature. We're going to do that. We will cheer if we see a 2 handle. But the question for the policymakers will be like, hey, is this sustained? Are we there? And that could take a bit longer. I'll give you a cyclical insight, which I think not a lot of people know, is that the trough in inflation has a cycle. The trough in inflation actually occurs after a recession is over, not before and not inside of it. All these things have lags. And so if we knew for darn sure that we were going to be at like 2% in, I don't know, the middle of next year or something like that, the odds are we had some more slowing than was expected.
We will see how all this plays out. Lakshman, you got to come and join us again very, very soon here as we head into what sounds like it's going to be a pretty uncertain time.
Well, uncertain time, but I would also say it's not the end of the world. Yeah. A hard landing and whatever, it's not the end of the world. We've survived 48 of them since 1790, and we will survive the next one.
Just got to hold on to when we start seeing that uptick again. All right,
exactly.
Lakshman, always great to have you. Thanks so much for stopping by with us. We'll keep right here on Yahoo Finance. We've got all your market action ahead. We'll be right back. The newest movie in the Marvel Universe making its debut at the box office this weekend, but to not so superhero results. Now, the Marvels had its worst opening for any MCU film, generating $47 million in ticket sales. Is it the end game for the franchise's popularity? More on this. We want to bring in Yahoo Finance reporter Alexandra Canal. Allie, what happened?
I know, not a great start for this film. And if you think about where the original debuted, it had over $150 million domestically before it went on to secure $1.13 billion worldwide. The sequel is not supposed to do this poorly. You're seeing the projections there on your screen now, up to $80 million for the debut. It got nearly half of that. And this is something that Disney has been struggling overall ever since Endgame in 2019. They really haven't been able to secure that super big blockbuster superhero movie. Now, that's due to a couple factors here. One, we had production delays due to COVID. And then when you did see movies return to theaters, audiences, they want something fresh. They want something new. It seems like there's a bit of superhero fatigue. Disney CEO Bob Iger, he even talked about how the company as a whole really wants to focus on quality over quantity. But you've heard analysts come out with recent notes saying, you know what, I think there's actually a couple more complex issues here. TD Cowen saying that Disney is going to have to make some difficult decisions when it comes to prioritizing what movies are for film, which movies should go direct to streaming, along with a better curated mix of products in the pipeline, and probably some new blood in the management ranks as well. Now, all this to say, we finally have the end of the actor strike. That should definitely help ramp up production. Bob Iger saying he was elated at that result, but at the end of the day, this isn't what you want to see. You don't want to see a movie do this poorly. The critic ratings weren't so good, but the audience ratings were good. So you have to wonder where it didn't quite connect with consumers.
Are we done with reboots yet at the movie theater, at the box office, or is there just more of that to come, especially given that now that you've got the strike behind us, a lot of the production houses are going to try and figure out what is the easy win that we can get?
Well, for a while, sequels, reboots, they were the easy wins, right? That was the guaranteed audience. That's what you can make and you would have a guaranteed return. Now it feels like audiences want something different. You can just look at the summer with the Barbie movie, right? That's something we haven't seen before. It was a female-driven movie, a female director. I mean, the Marvels was female as well, but didn't quite resonate. It seems like consumers want something different, want something fresh and new. So this is something that studios across the board are going to really have to think about when they think about, production down the line.
They certainly will, and they're trying to figure out everything they can to get more people to the movie theaters. All right, Allie, thanks.
Well, last week, the Screen Actors Guild strike that came to a close, and the 118-day strike was one of the longest that Hollywood had ever seen. Union members were demanding wage increases, streaming revenue compensation, and protection of their likeness from AI from major studios. Well, strikes are over, so now what? Many of the movies and television shows we love will now resume production. For more on what we can expect from the entertainment industry for the remainder of the year, here in studio at Yahoo Finance, we've got Richard Gelfond, the CEO of IMAX. Richard, great to see you. You see the news come across. What was your immediate reaction? What went through your mind?
My immediate reaction was ecstasy. I was actually at a benefit, and I started high-fiving random people, and they thought I had too much to drink. But then I explained the reason was, joy that finally that cloud lifted up. I think it could have been settled sooner. I think, as in these things always, people get really dug in, and as you know, the ideal settlement is no one is completely happy, but they're always afraid to make that leap. But my understanding now is that most on the film side anyway, I don't know that much about the television side, that the films that were in production are basically going back into production quickly. So films like Deadpool that were, partially shot, they had known for a while that they were going to resume. So there's a pretty quick resumption to that and what's going on. And other things like reshoots are happening quickly. I think films that are not yet in production, it's a little bit more complicated because you have stars who have different commitments for different periods of time, and you've got to juggle things. But I think the 24 slate is going to be fine, and I think the 25 slate is going to be phenomenal from what I know already.
Richard, when we talk about what's needed to get people back into the theaters, and you have a unique perspective at IMAX because it's much more of an experience, something that the consumer is willing and wants to spend money on at this point. Now that we do have the actor strike resolved, when you look ahead to the 2024-2025 film slate, which ones are at the top of the list for you in terms of where there's that hype, where there's that expectation that we're going to see people come back in large amounts?
Well, it's still early to say. But I think Dune Part 2, which is coming out in March, there's a lot of expectation for that. And as you know, it's Timothée Chalamet, Zendaya, Austin Butler, Florence Pugh, fantastic cast. And people at IMAX have seen part of it and have very high expectations for that. I think you've got to say The Joker later in the year is going to be fantastic. And as you know, that's with Lady Gaga and Joaquin Phoenix. And then Deadpool coming out during the year, certainly high expectations. And then later in the year, the prequel to Lion King. And when you look ahead to 25, you got the new Superman DC reboot coming out. You have Formula One with Brad Pitt coming out then. I mean, 25 kind of, Avatar coming out again. How could you forget Avatar?
Again.
There's a lot out there.
There is a lot out there, and that brings me to the whole sequel discussion and what we were just talking about with Ali Canal. When you take a look at what happened at the box office this past weekend, yes, it was just the debut weekend, but the Marvel franchise seems like it has fallen out of favor with viewers. Is that fair to say, or is it still too soon?
Well, it's definitely too soon. I mean, it's made 20 but $30 billion, I forget. I get my billions confused. But, you know, Bob Iger himself said that maybe it had gotten spread a little too thin between television and too many releases. And I think that's one of many factors. But I also think it's always dangerous to jump to conclusions too quickly. So after the opening weekend of Avatar, people were betting against Jim Cameron. And then when they heard what Chris Nolan was working on, they said, oh, a movie about, you know, a physicist, that's not going to work. And almost $1 billion later, that was wrong. And I wouldn't bet against Kevin Feige. You know, my money's on him. Yeah.
You mentioned some of the films coming out, whether it's a prequel, and I would love to know more about Mufasa himself. I need a prequel to The Lion King. Not enough of us got to see enough of Mufasa. R.I.P. Mufasa.
But he was cute.
He was cute. I mean, Simba, Mufasa, the whole family, Scar. You know, he doesn't need to show up at Thanksgiving. All that said, though, what are the titles that are going to drive more sign-ons for IMAX when you're thinking about licensing that technology, bringing the experience to new theaters? Those theater operators also have to consider what are the titles that are going to be best displayed on IMAX, and do we have enough of them to justify this?
Well, as you know, we reported 2 weeks ago, we had the second best quarter in our history in Q3. We have 125 signings for new theaters, which is more than double last year. So I think just more of the same, and I'm not sure, back to the discussion you had earlier, I'm not sure whether it's going to be sequels or original IP, but some combination of both. And I think you have enough of that coming out, you know, looking into the future. I had mentioned, you know, Formula One, which is Joe Kosinski, who directed Top Gun, and Jerry Bruckheimer and Brad Pitt, that's original IP. You have Superman, which is existing IP. You have Dune, which is somewhere in the middle because Denis Villeneuve has a very different take on it. So I think whatever's been working for IMAX, our market share is up 50% in North America over pre-pandemic. You know, I think the mixture will continue to work.
Well, and we got to go, but what about concerts? I mean, you've got the Eras Tour that had been displayed in movie theaters. You've also got the Renaissance Tour that's going to be displayed in movie theaters too.
So as you know, Taylor Swift concert's done over $200 million. The Beyonce concert we are involved in, extremely excited about. I don't think that's going to be a big part of the movie business. I think alternative content is a rising part, and maybe part of what you were saying before about original IP, but there aren't a lot of Taylor Swifts and Beyoncés out there.
Yeah, I know. We can all try our best here. Richard Gelfond, CEO of IMAX, thanks so much for joining us in studio today.
Thank you both.
Absolutely. Everyone, we've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Few words are as emotive in American discourse today as healthcare. It's an industry and a system that both insiders and patients agree is broken. From affordability and access to the government's drug pricing negotiations, the challenges are endless. Meanwhile, big box and digital health are pressuring traditional systems. Companies like Amazon and Walmart are thinking about how to get you to think about healthcare while you're shopping. Then there's the excitement and apprehension around AI and what its role is in healthcare. And of course, the buzz surrounding the newest weight loss and diabetes drugs and what it means for other industries. We'll tackle all this and more in a special series starting November 13th, only on Yahoo Finance.
We've got some big stories on tap next hour. Akiko and Rochelle will speak with Piper Sandler's Jason Glazer on his 6 stocks that you should consider buying.
And plugging in, we will hear from the CEO of Blink Charging. He will give us a deeper look and some insight into the state of the EV charging industry.
Plus, actors strike no more. So what's the timeline for the return of your favorite shows? They'll have those details coming up next.
All right, let's do a quick check of the markets. Just about 90 minutes into the trading day. You're still looking at a bit of a mixed picture. The Dow just above the flat line there, but you're looking at the S&P off about 0.2%. The Nasdaq off about 0.3%. And digging into some of that sector action, we were looking at some of the weakness in the technology space earlier today. The XLK off at just about 0.7%. Communication services also among the underperformers in today's action, as well as real estate and utilities. On the flip side, energy and consumer staples outperforming so far.
Yeah, Boeing leading the Dow, Nike bringing up the caboose right now.
There we go. All right, well, that does it for us right now. But keep right here on Yahoo Finance. Rochelle and Akiko have you for the next hour. We'll see you tomorrow.
Welcome to Yahoo Finance Live. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita with Rochelle Akufo. Here's what we're watching at this hour. Retail realities. All eyes are on the state of the consumer this week with earnings from Walmart and Target on tap. Will the former grocery business make it all the difference once again?
And plugging in, Blink Charging saw revenue jump 152% year over year. But what does EV demand signal about the road ahead?
Plus, strike no more. Actors and studios have reached a deal following a historic 118-day standoff. So, what does this mean for your favorite TV shows and the state of the 2024 box office? We'll discuss straight ahead.
Indeed. But first, let's take a look at how markets are faring an hour and a half into the trading day. Seeing a lot of volatility this morning as all three major indices off their session lows, but still in the red, reaching for daylight. The Dow there oscillating back and forth, just barely to the upside, up about 6 points. S&P 500 there also to the downside by about 6 points. Tech-heavy Nasdaq there down about 0.25% there. Mixed picture for the Magnificent Seven there. Half of them not doing so great in the red so far this morning. Awaiting a lot of key inflation data and, of course, in the middle of earnings season as well. Let's also check in on the Treasury market as well. Looking at the shortest term 5-year yield, that's up about 0.65%. The 10-year also seeing ticking back up there, up about 0.9%, edging ever closer to that 5 mark. And then looking at the longest 30-year yield, that's up about 0.9% as well. Well, the retail sector is in focus this week with big box stores reporting their results. Plus, on the data front, we have October's Consumer Price Index and retail sales. Here to break down what you need to have your eye on this week is Yahoo Finance reporter Josh Schaefer. Josh, what are you watching?
Hey, Rochelle. Yeah, so I got the earnings calendar next to me here, specifically focusing on retail. So you can see we get a wide range, a wide look at the consumer when you think about starting with Home Depot. Of course, that will be some home improvement buying and sort of what's going on in that housing market. Are people moving or are people still renovating their homes at home, as we saw a lot over the pandemic? We know those trends have sort of shifted. Then you take a look at Target, TJ Maxx, Walmart here on Thursday, and BJ's on Friday. So really a wide look at the consumer, and I think that's going to be a big trend overall when we think about the week. So when you think about what we have for the economic calendar, here is the expectations for CPI, inflation. This comes out tomorrow, 3.3%. Headline inflation, a lot of that coming down from 3.7%, largely driven by the fall we've seen in energy prices over the last month. This is usually the big one though, right? Core inflation, this is what the Fed looks at, looking to see prices increase 4.1% in the month of October. That would be in line with what we saw last month. So perhaps the inflation number not moving down quite as much as the central bank would maybe hope. And another one I'm watching this week, guys, is retail sales. Retail sales out on Wednesday, and you can see it right here, expected to drop off in October. This would be a big drop for retail sales. We have not seen retail sales fall on a monthly basis since here in March. So to see that fall off, remember, we've been talking a lot about how the consumer is feeding this economy. The consumer is why the economy grew about 5% last quarter. That's what's been driving the surprising growth. So we're going to get a look at if that's continuing for the start of the fourth quarter. A final chart to show you just when we think about the consumer. I was looking at this one over the weekend. It really just caught my eye. This is Walmart and Target. This is Walmart's stock performance this year, up 17%. This is Target's, down 27%. When you think about these retail earnings and what we can learn this week, it's not just about the consumer, it's about which consumer and who is holding up. Target, obviously a very discretionary company with how much they sell in electronics beyond groceries, versus Walmart, considered more of a consumer staple, the kind of company that benefits from trade downs. A lot of strategists right now talking on the street. Yes, maybe the consumer's doing okay, but that doesn't mean every company that sells to consumer is doing okay. So it'll be interesting to parse through those reports as we go through the week.
Yeah, some key indicators there, Josh. Particularly going to be important to see Walmart, because we have seen a lot of sort of higher income shoppers coming through the door, and they've highlighted that in the past. Josh Schaefer with a breakdown of a look ahead this week. Thanks so much. Well, fears of a potential government shutdown loom large once again as congressional gridlock shows no signs of loosening. Newly elected House Speaker Mike Johnson says he intends to avoid a shutdown that would start this upcoming Saturday. He unveiled a two-step temporary spending plan with deadlines to pass permanent department budgets dated in January and February. Johnson's bills are getting pushback from the far right because like the stopgap bill that led to the historic ouster of former House Speaker Kevin McCarthy, these bills don't include any spending cuts. That's a bit of the irony, right? Rochelle, after all of this, finally have a House Speaker in place. And by the way, what he's proposing is very similar to what former House Speaker Kevin McCarthy proposed as well. Let's kind of walk through what that looks like, though. First of all, we're talking about a two-step solution that means, number one, getting funding extended through January 19th. And that would be for military construction, Veterans Affairs, the Energy Department, among others. And then additional funding extended through for the other agencies, other programs in February. At the end of the day, there's still no real long-term solution in place, Rochelle. And by the way, Moody's already moving to downgrade outlook on U.S. credit rating from stable to negative. So, you know, how do the markets react? We've seen from the past that they sort of stay on the sidelines and watch until something happens. And that something could happen several days from now.
It's true. I mean, it's a case of deja vu because, as you mentioned, same situation that Kevin McCarthy was in, and still going to need help from the Democrats to get this through. Because even when you look at the deadlines, they're very close together, so there's not much difference there. And also not the spending cuts that a lot of the hard right were looking for. And even when we look at Moody's economic downgrade, the outlook to negative from stable, citing those growing fiscal deficits, higher interest rates, lack of effective fiscal policy measures, but also a lot of the political conflict, which it's sort of this self-fulfilling prophecy here. And even when you think of the potential for the impact on Thanksgiving travel, you think of TSA employees, federal air traffic controllers, they're actually going to be getting their last paycheck, according to The Hill at least, right as the government shutdown would be happening. So you shouldn't have to worry about your travel, but something to worry about if this continues. We know in 2019, they started calling in sick after several weeks, and we really don't know what's going to happen at this point, especially with a new speaker on tap as well.
Yeah, that's an important point to note, Rochelle, when you think about the real life impact that could happen from any kind of delay in extending this funding, but certainly going to be watching.
All right, well, stay with us here on Yahoo Finance Live. We have much more coming up. Stay with us.
Stocks have picked up again in November after a 3-month slump, with the S&P 500 up 5% and the Nasdaq up 7%. Investors already looking ahead to the Santa Claus rally. Let's bring in our very own Jared Blickery, who is here with what to expect. Until then, Jared.
Yes, it's never too early to talk about Santa Claus. We got pumpkin spice latte in the rear view mirror for 2 months. I'm looking at the VIX right now. A couple of seasonality notes. Seasonality is what stocks or any instrument tends to do over a protracted period of time. The most common one is calendar seasonality, and we've seen that really work in favor of stocks this year, the third year of the presidential cycle. Here's what we're looking at in the volatility index. Now, this runs inverse to stock prices. So when you see a big spike like we had in March of this year, well, that tends to be when stocks are going down. And indeed, we had that mini bank crisis. Now, stocks have been kind of precarious at times this year, but we had just coming off a magnificent run up here. Part of, I guess, helped in part by the Magnificent Seven, and also helped by a drop in volatility. This is implied volatility, which was dropping for 8 days straight, and now it's ticked up a little bit. But suffice to say, it is moving in the right direction. Simultaneously, we have net bearish bets among leveraged funds. Those are hedge funds. You can see those are still short. If it's positive, that's an expectation that prices are going to go up. But this tends to be a contrary indicator. So you actually want to see this at extremes, and that's probably going to give you more of a turnaround indication. Right now, in the middle of this range here for 2023 and 2022, it is saying that there is probably a bullish tilt, a bullish bias, just given the positioning that we have of hedge funds, which is a bit bearish right now. Also taking a look at short interest in the Magnificent Seven. This goes all the way back to 1995. So some of those weren't even in existence back then. But nevertheless, you can see not too much short interest right here. But I would say that nevertheless, despite all this, we've seen a huge contribution from the Magnificent Seven stocks this year. And finally, want to take a look at call options volume. This has been a factor in years past, especially 2 years ago in 2021. We saw huge run-ups in stock prices concomitant with this huge run-up in call option volume explosion. This little peak right here, this was taking place with a rally in stocks a little bit earlier. Anytime you see one of these, it tends to create a positive feedback loop where options dealers, what they need to do to hedge their bets against the people buying and selling options, they tend to drive prices up in a feedback loop. So what I'm showing here is that we've finally seen kind of a resurgence of this. Haven't seen too many of those since we got that big bearish stock market last year, which has morphed into a bull market this year. Haven't really heard about call option volume too much. Now, a little bit of cold water, have to go with one potential headwind here. That is the 10-year T-note yield. Now, this is up quite a bit. You can see from where it was down underneath 3.5% all the way in March, and that was during the mini bank crisis that I've talked about here, all the way up to 5%. And the latest run-up in prices that we saw in the S&P 500, that was on a drop from 5% to 4.5%. Suffice to say, if we see the 10-year surge above 5%, that's probably going to put a damper on any expectations for stockholders going into the end of the year. But not to get too far ahead of ourselves, hasn't happened yet. And we do see the 10-year hovering around 4.66% in safe territory for now, guys.
Indeed, for now being the key phrase. Always great to have your insights. Yahoo Finance reporter Jared Blickery, thanks so much. Right, are you in the market to buy a home? Well, you're competing with the typical home buyer whose annual income is at a record high. The typical home buyer is raking in $107,000 per year. This is according to a report out this morning by the National Association of Realtors. Jessica Lotz, National Association of Realtors Deputy Chief Economist and VP of Research, is here to break down this report for us. Thank you for joining us this morning. So, as we're looking at especially these first-time home buyers, they made up 32% of all home buyers, up from last year's historic low, but still below average. But talk about the demographics. Who are these home buyers who are snapping up these deals?
Well, they're wealthier. We know that the typical home buyer, especially for a first-time home buyer, they're essentially making nearly $25,000 more than they were last year. So they have to be higher earners to actually enter into today's housing market. They're also tapping their assets. So they're looking at their stocks, they're looking at their 401k, even cryptocurrency to put down as a down payment.
With that said, I mean, this is a really tough market. We've talked so much about the higher rates, specifically on the 30-year fixed, but also the fact that there are those who are looking for their second home who have equity already built up. So how does that stack up for the first-time home buyer when inventory is so limited?
Well, that's the thing. And that's why we're seeing still historic lows of first-time home buyers, is because inventory is incredibly limited. If there's a multiple offer situation, that repeat buyer who can put down a larger down payment than they have historically is going to win out on that bid. And in fact, we've seen actual down payments go up to a 20-year high, both for first-time and for repeat buyers. And I think that speaks to first-time home buyers saying, look, I have the money. I want to enter into the market too. Please accept my bid. But we're still seeing that repeat buyers are winning out.
And I want to talk about household composition and how much that's changed and how that's affecting who's able to afford some of these homes and where they're buying.
Right. So we're seeing that married couples are dropping, but what we see overall in the US is that there's generally a smaller share of married couples today. So we see more single women entering into the market. I think this is amazing. We see that they're competing against these repeat buyers who have higher incomes. They're saving for longer periods of time. But I have to say that housing affordability is going to impact these singles more than we would see for married couples.
Jessica, that 30% that you alluded to at the top of first-time home buyers who are snatching up these homes, how does that compare historically?
So historically, we've seen that first-time home buyers are 38% of the market. So we do still see that they're lower than what they have been historically. Yes, we do have a higher share this year than last year, but we're still near historic lows, unfortunately.
And Jessica, I want to ask you about home sellers, because we've been talking a lot of people sort of with their wealth locked in their houses because of their equity. Talk about the typical seller right now and what they're looking for.
Well, the typical seller is essentially someone who may be a retiree or thinking about retirement pretty quickly here because the median age is 60 years old. They have a lot of housing equity, so they're able to make these trades where they want to be, looking at their ideal location, perhaps in retirement. And we also know that they've been in their home for a decade. And overall, our analysis shows that that's about $200,000 in housing wealth that they could be sitting on.
You mentioned the 38% where it used to be in terms of first-time home buyers. What's it going to take to move the needle further? Does it come down to the rates coming down, or is it about inventory more?
I think it has to be both, and both of these things need to be out in the environment for us to see more first-time home buyers. And the reason why is because if we have lower rates, that's going to be wonderful for buyers who are sitting on the sidelines, but we're going to have multiple offers coming back, and perhaps those repeat buyers who are also sitting on the sidelines saying, I want to be in this lower interest rate home, I'll move into the market. And so that's going to put a lot of pressure on multiple bids coming back. And I fear for the first-time home buyers in that scenario, we need the inventory to support all buyers right now.
And Jessica, as you look at the industry itself and how much it's changing, obviously a lot of focus on commissions, a lot of people deciding not to go with a traditional real estate agent and looking for some of these online options. How does that affect affordability when people are thinking about how much they can spend on a home?
Well, I have to say that one of the things that was really impressive to see this year is that 89% of buyers and sellers used a real estate agent or broker. This is the biggest transaction of their lifetime. This is financial pressure, but it's also where they're going to live. And so they want to make sure that they're making the right decision, and they want an expert by their side as they go into that transaction. And we're seeing that agent adoption is up because people need that agent.
Jessica Lotz, National Association of Realtors, Deputy Chief Economist and VP of Research. Good to talk to you today. Appreciate the time.
Thank you.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
US meat packer Tyson Foods is out with its fourth quarter earnings report. The company missed sales estimates but beat on the bottom line. Brooke De Palma joins us now with the details. So, Brooke, what are your main takeaways?
Good morning, Rochelle. With that, it certainly was a mixed results quarter for Tyson Foods. The meat producer posted revenue coming in at $13.35 billion. That was lower than analyst expectations, and earnings per share coming in higher than expected. But the big takeaway here is that there was falling chicken and pork prices that did lead to that lower than expected sales. We did see volumes drop more than expected in beef and pork as consumers become a bit more pinched and a bit more choosy about where exactly they'll spend when it comes to their poultry, their meat, their beef. In addition to that, chicken volumes did grow at a lower expected rate as well. The company did say that the cost to buy cattle to process into beef increased about $2.1 billion in fiscal year 2023 from the previous year. They also said that they're seeing a U-shaped recovery in terms of cattle supply. But in addition to that, they continue to push their processed food category. That did get a nice pop in volume growth of about 1% last quarter. That is really a growth engine that Tyson Foods says will lead to more profitability.
Brooke, we know Tyson got a lot of attention this year over the closure of more chicken plants. Where do those stand right now?
Yeah, Kiko, that got a lot of attention during Q3 and Q4 during this company's earnings call. The company did provide an update on that. Their Tyson Foods Poultry Group president saying that 5 of the 6 that they announced are in fact done producing, with the last one coming offline in March of 2024. They said in their Q4 financials, only 2 of those would have been driving those numbers, with the remaining ones coming in Q1 and early Q2. But in addition to those closures, they are opening 2 new facilities, once again really looking to that chicken added value, more prepared food categories. We'll see a new cooked chicken plant come into play this month where it'll produce snacks and chicken nuggets. And we'll also see one in early 2024 that will be producing prepared foods. And so certainly they're doubling down on different ways to drive profitability and ultimately going where the consumer is buying more.
Indeed, the consumer's still looking at snacking and convenience there, so interesting to see that growth and expansion. Brooke De Palma, thank you so much. Well, this week you'll be able to get your hands on Sony's latest product. Sony is launching a new handheld console called the PlayStation Portal. Now, the portable device will be able to stream PS5 games over Wi-Fi on its 8-inch screen. For more on this, Yahoo Finance tech editor Dan Howley is here. So Dan, break it down for us.
Yeah, I actually have the PlayStation Portal right here, and you can see I'm streaming directly from my PlayStation 5 at home. This is the new Spider-Man 2. Marvel's Spider-Man 2 is the technical name. It is an 8-inch display. It basically has 2 PlayStation controllers divided in half that you just kind of hold on to, and you can stream from basically anywhere as long as you have a strong enough Wi-Fi signal. I'm actually, believe it or not, using my phone as a hotspot to be able to stream from my house. My wife's at home, and basically what's going on there with my PlayStation, which is doing all the heavy lifting, is if you have the TV on, you're just seeing exactly what I'm doing here. So the interesting thing about this is you can use PlayStation's Remote Play, which is the service that this depends on things like your smartphone, an iPad, a PC from a website, things like that. So it's not unique in the fact that it can stream from a PlayStation. What's unique about it is the form factor. It's purpose-built for this. Now, does that necessarily mean that you need it for Remote Play? You can use a DualSense controller, the regular PlayStation 5 controller, with an iPad, your PC, or any other device really that connects to Bluetooth already. So you don't necessarily need this for those capabilities. The other downside to this is you can't watch Netflix on it. You can't stream from the cloud on it using PlayStation's, the PlayStation Plus cloud service. You only can stream from your physical PlayStation 5. It is $199, so it's not going to break the bank necessarily, but that also means you have to have that PlayStation 5 console already. So that's $199 on top of that price. I do think that if you're the type of person who wants to be able to play in bed, on the road, I'm going to be traveling on vacation, I'm going to take this with me. Obviously, I won't be able to play it on the plane because plane Wi-Fi is not going to be able to cut it. But from a hotel room, it will. From my smartphone, it will. I do just, I think that there's more capabilities that they can squeeze out of this, that cloud gaming, that ability to perhaps stream Netflix, that ability to perhaps get Hulu on here, YouTube, things like that. As it stands, it's kind of confusing. I can do all of this already. It's $199. It's a beautiful device, but there are other products that are handheld that allow you to do a little bit more. For instance, the Switch doesn't have the streaming capabilities. It won't have the graphical wizardry of something like this, but I can play it without Wi-Fi. So I can sit on a plane or wherever and be able to play games. There's also something called a Steam Deck, which is made by Valve. That allows you to play PC games on the go without an internet connection. So, you know, it is kind of sitting in a unique space. $199, again, not going to break the bank. But I think for most people, if you can do this on an iPad already, it's not necessarily worth your while to get this on its own. But if you're like me and you're a gamer and you want absolutely everything gaming related, then it's going to be worth it. And hey, that's the opening credits for Spider-Man.
Right on cue there, Dan. No streaming and no cloud access seems like a big downside.
Yeah.
To your point, we'll see if they expand beyond that. Dan Halley, as always, appreciate the product review there. Well, Christmas may be coming early. Market bulls are hopeful for an end-of-year rally. Despite a bit of a flat trade in stocks this morning, the market's moves on Friday sent all three majors to their highest close in nearly 2 months. A new report from Piper Sandler's technical research team names 6 high-conviction stocks that look attractive for investor portfolios right now. Let's bring in one of organizers behind that report. We've got Jason Glazer, Managing Director and Head of Product Management at Piper Sandler. Jason, this is always an interesting report. Before we have you break down those 6 stocks, walk me through how you got to that.
No, well, first of all, thank you for having me this morning. So, you know, how did we get here? We continue to hear from investors in such a challenging and uncertain market is we want high conviction ideas. And how do you ferret that out? And what we did was combined our macro research, which consists of our portfolio strategy team's work and our technical analyst work, with our stock analyst work. And if you look at the Piper Sandler universe, we cover almost 1,000 stocks, and about 570 are overweighted or buy ratings. We take our portfolio strategies model, which is called Macro Select, and right now it's looking for high quality. We define high quality as stocks that have strong earnings growth, profitability, strong returns, as well as being low beta. And they screen up about 50 plus stocks that rank in their top decile from that universe of overweights. And then our technical analyst takes a look at the charts, and they get me about 15 to 20 stocks that make it through the 3 screens. And then I follow up with our stock analyst to make sure fundamentally that these are some of the highest conviction ideas. And that makes it easy to go out to investors and say, these are stocks we truly like, top down and bottom up.
And Jason, I mean, we're seeing a lot of tech companies on that list, but walk us through Lululemon being on that list. What makes them a standout here in this crowd of tech?
So Lulu stands out. Obviously, everyone knows the brand. It stands out because it has both high earnings growth and earnings expectations. And if you go into the business, they have pretty high margins, with about 45% of sales coming from company-owned stores and about 45% of sales coming through the e-commerce channel. They're tremendous at product innovation. They keep high, full price selling, unlike a lot of the discounting you see in the retail industry. And they also have some tremendous growth opportunities in China. So when you kind of break it down, it is attractive on the chart. It looks relatively strong compared to the retail group. And we think that the positives are going to continue to be a tailwind for Lulu here.
Let's talk about a name that investors are very familiar with, Amazon, among those top 6. Why does it make sense to get in at this price point?
No, fair question. We all know and use Amazon. I think one of the things to think about it is not only does it have strong earnings growth, but it's got earnings momentum. The AWS business, which had faced some challenges as you saw some cloud optimizations, i.e. some cost controls, we're starting to see that stabilize. And in fact, AI workloads are, if anything, likely to increase cloud business there. The core business, I think, has been doing well and has seen improving margins. And frankly, it's another one where The chart looks good. It's and again, we think relative strength, even to a strong tech group, it looks good to us. So we think the good news is going to continue for Amazon, both with the AWS, the core business, even a small business advertising. We think could ramp up to be as big as $50 billion.
And Jason, keeping an eye on biotech as well, I see Amgen on this list. How does it, when you compare it with its peers, what made it a standout to make your cut here?
Right. It's Amgen. I know biotech's had a tough go of it, although at least we got some good news from the GLP-1s over the weekend. But, Amgen is a highly profitable company, but it's also a low beta, which, in a backdrop of a market of uncertainty, you want to find stocks that are going to be low beta, lower volatility. It's completing its acquisition of Horizon Pharmaceuticals. They're going to layer in a tremendous drug, Tepezza, which we think on the Amgen sales force can show significant improvement. They've got 2 pipeline drugs in obesity, earlier stage, but we're going to get some data next year. So we think Amgen offers a lot of stability for investors, as well as offering growth in the future that may not be into the numbers and into the stock quite yet.
Finally, Jason, we've got to touch on the energy space. Coterra, one that you're watching closely. Sure, it's not what we saw in terms of the energy space last year, but what's particularly attractive about this name, given the current environment?
No, absolutely. I mean, we definitely say, just looking at the oil price, it feels like any, greater war theater in the Middle East is definitely not priced into oil right now. Whether that's right or wrong, we'll find out later. But for Coterra Energy, they are one of the absolute best operators in the Delaware Basin. They have a balance sheet that should be debt-free next year, which should have great implications for shareholder returns. They're also saving, at least a couple $100 million in the Marcellus, and can deploy that in the very high return Delaware Basin. So we think Coterra, company specific, should be in tremendous shape. Again, relative to the group, it looks quite attractive here. That fits the screen of being high quality in this uncertain market.
Well, I appreciate you taking the time to break down those insights. Interesting report there. Jason Glazer, Managing Director and Head of Product Management at Piper Sandler. Great to have you on.
Thanks.
All right, oil markets action ahead. Stay tuned. You're watching Yahoo Finance.
United Auto Worker laborers at Ford's Louisville plant have voted against a tentative deal with a car maker, the local unit said on Facebook. The vote signals approval of the deal isn't guaranteed. Ford previously pulled its full-year outlook thanks to uncertainty around the agreement's pending vote. Let's bring in Yahoo Finance senior autos reporter Pras Subramanian. Pras, what does that mean in terms of where things move forward from here?
Hey, Kiko. Yeah, it's a slight hiccup here as UAW workers at that plant, which makes the Super Duty trucks and full-size SUVs voted 55% against ratifying that new contract. Now, the union did not disclose overall percentage of votes in favor or of the deal or how many votes were cast. Now, you asked what this means. This also follows a similar GM vote at the Flint assembly plant where nearly 52% of voters voted against the deal. So the big picture stuff here is the votes have been coming in overall in favor of the deal, and it's an overall majority of votes across all plants that determine whether the deal is ratified, not just one plant. So it's still looking likely, and the automakers and the union are still cautiously optimistic at this point.
And Pras, of course, there are some industry reports signaling that electric vehicles demand may be slowing. What are you seeing? And give us some context here.
Yeah, there was a pretty interesting report out of the FT this morning indicating that automakers were cutting prices of EVs globally to boost demand. In the U.S., EV discounts in October hit 10%, and the number of EVs with discounts tripled over the past 12 months, according to the data. But the wrinkle is that EV sales are actually higher, climbing higher here. KBB found Q3 EV sales top 313,000, a 50% jump from a year ago, and EV market share hit 7.9%. Now, the issue is that these EVs and their gas counterparts are seeing wide spreads in price. JD Power found that the average compact EV SUV costs $52,000, but the comparable gas-powered SUV costs only $34,000. So that's a big reason why we're seeing a lot of discounts. Yes, there might be some buyers who won't go all electric right now, but for a vast majority of buyers, they just can't afford to go electric, at least not yet.
Indeed. Well, thanks for getting us up to speed. Our very own Pras Subramanian. Thanks as always. Well, it was an electric third quarter for EV charging company Blink. After handily beating its full-year revenue target in the third quarter, the company raised its outlook for the year, thanks to robust demand and higher network use fees. Now, despite some industry reports of slowing EV demand, Blink is forecasting the market for chargers to grow, and with it, the demand for more robust charging infrastructure. The company now has its sights set on hitting positive adjusted EBITDA run rate by December of next year. Joining us now is Brendan Jones, Blink Charging CEO. Good to have you on the show here. So walk us through your base case in terms of your outlook here and what's driving your optimism.
So what's driving our optimism is, while there might be some occasional slowdowns, EV adoption on an aggregate level is going up. And that's just not in the US, but that's globally as well, led by China, Europe, and the US lagging a little bit behind. If we look at a base level estimate, we're estimating that 35% of the aggregate TIV in total industry volume needs to be 35% EVs by 2030. And that's a low estimate. To give you an idea, California was at 25 just a couple months ago of EV pen rate. If you look at how many chargers you need, that's already 30 million chargers that need to be in the ground, whether private or public, by that period of time. So that's an enormous market. And the numbers get even larger as you go out to 2040 and beyond. And we also know that in a multiplicity of states, California being one of them, which is the fifth or sixth largest economy in the world, you won't be able to buy and turn an internal combustion engine after 2035. So there's a little bit of a forced mandate on this and a little bit of natural growth. Now, what we're also starting to see is the cars, the variety of them are going up. There's even more investment coming from the OEMs coming into the marketplace. And then the adoption rates are going up over time. Now, clearly, what the auto OEMs need to do is bring in more affordable EVs that have more parity with internal combustion engines. And we see that happening as well.
So, Brendan, adoption rates going up, but you could argue things have been slowing. It looks like we may have lost your connection there, but hopefully you can still hear me, Brendan. The reality is one of the biggest challenges has been about the charging infrastructure. You specifically highlighted sort of the DC fast chargers being a larger mix of the revenue pie long term. Why isn't it a larger mix right now? What's the hurdle here? Okay, looks like we lost Brendan's signal. We're going to see if we can get that up and running. But his share's doing well today. The stock, they're up more than 9%. We're going to take a quick break here. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
It was an electric third quarter for EV charging company Blink. After handily beating its full-year revenue target in the third quarter, the company raised its outlook for the year, thanks to robust demand and higher network use fees. Despite some industry reports of slowing EV demand, Blink is forecasting the market for chargers to grow, and with it, the demand for more robust charging infrastructure. The company now has its sights set on hitting positive adjusted EBITDA run rate by December of next year. Joining us now, Brendan Jones, Blink Charging CEO. Thank you for joining us again, Brendan. So talk about this bumper third quarter that you had here. What does that mean in terms of where you go from here in terms of capturing more market share and also growing your customer base as well?
Yeah, it means as we continue to do what we're doing, and that is focus on our fundamentals to grow the strength of the company and continue to capture market share. And that market share is coming from the fleet space, multifamily dwellings. It's coming from municipal charging. And what we have to focus on is the majority of charging we install and own or operate is a level 2 charging, which including the Bloomberg, Price Cooper's Waterhouse, and many other research firms. That's going to be 90 to 95% of the charging that takes place globally. And it's also economic to install. So what we're finding out now, as there's lots of talk about DC fast charger, the real charging solution that's going to take care of the majority of people who buy electric vehicles is level 2. And that's where you saw the robust sales coming in. But also, we do quite a bit of work on DC fast charging as well. And that's primarily for public use and fast charging. That is expanding dramatically. And the other thing we can look at is the numbers. By 2030, we need 30 million chargers in the US at the current pace. So that's a huge amount of market share. So what Blink needs to do is make sure that
Brendan,
as a result, yep.
Let me follow up on that level 2 comment you just made. Why is the vast majority that you're looking at going to be level 2? I mean, I will say as an EV driver myself, hours and hours of charging it takes a little patience, right? You could argue that the reason why Tesla has done so well is because they have those superchargers in place. Why isn't the bigger chunk DC fast charging? Is it infrastructure? Is it a cost issue?
It's not, and it's also convenience. What level 2 charging takes advantage of is dwell time. Unfortunately, according to the Department of Transportation, the vehicles sit 95% of the time. So it's easy to charge them when they sit. Even on Tesla cars, the majority of their drivers charge at home and charge where they have high dwell time. And then when they need a quick fill up, they go to the supercharge stations. So that's the reality in charging globally, is we only have so many capital dollars to put chargers in the ground. Use them economically. Charge where put the chargers where people dwell and where they sit, at home, at the grocery store, at the ballpark, wherever you need at healthcare facilities.
So Brendan, say you are a Tesla driver and you're seeing these options here. What would make them pick a Blink charging station versus if they could go to a Tesla supercharger? What's the appeal for some of these other manufacturers?
Yeah, quick and convenient. Supercharge stations are typically located outside of the metro area. If I go outside to the garage located next to the building here where our headquarters is, I'll find 5 Teslas charging up on Blink L2 chargers. It's convenience. So public L2 and multifamily dwelling and feed L2 is the way to go in terms of quick economic charging. DC fast charging, which we do, you can do, but it's about a 21 ratio on the economic cost, much harder to install on that. So you're going to see this balance. About 10% are going to be DC fast charging. The other 90% will be L2. And that's for both fleet and for personally owned vehicles.
Brendan Jones, Blink Charging CEO. Good to talk to you today. Appreciate the time.
All right. Thank you very much.
After a historic 118-day strike, studios and actors have finally reached a deal. SAG-AFTRA's national board revealed the package had been approved by 86% of voters and now heads to the union's member base. But what does this mean for your favorite shows and movies? Let's bring in Ali Canal, who has the details for us.
Hi, Akiko.
Ali, what does the pipeline look like?
Well, the good news is, Akiko, that these actors can now finally immediately return to work, which means the return of some of our favorite movies and TV shows that will be resuming production, or at the very least, they're expected to resume production over the coming weeks. If we take a look at some of the films that we should see ramp up those productions again, that includes movies like Gladiator 2, Deadpool 3, Venom 3, It Ends With Us, among many, many others. And this is certainly a big sigh of relief for studios that have been really wanting to get those films back up and running to fill out the rest of the theatrical slate for next year. And then for TV shows, we're going to see series like The White Lotus and Stranger Things pick up on those productions as well, which will make a lot of viewers very happy there. But just because these films and TV series are coming back doesn't mean that we haven't already seen some serious delays. Disney recently announced to push back the release dates of multiple films, including Deadpool 3, Captain America, Thunderbolts, and Blade. As it stands now, Deadpool 3 will be the only Marvel film to open next year. We also saw Sony Pictures postpone the 3rd installment of its Venom franchise. Warner Brothers' Dune 2 pushed back, along with Paramount's Mission Impossible Dead Reckoning Part 2. So we're going to see likely more delays in the coming weeks. But we did speak with IMAX CEO Richard Gelfond earlier today, and he's pretty confident when it comes to the future of the box office. Here's a bit more of what he had to say.
Films that are not yet in production, it's a little bit more complicated because you have stars who have different commitments for different periods of time, and you've got to juggle things. But I think the 24 slate is going to be fine, and I think the 25 slate is going to be phenomenal from what I know already.
Yeah, so perhaps a bit of bumpiness in 2024, but overall still very reassuring that we were able to get a deal done before the end of the year.
Indeed, I know we were worried about that deadline and what that would mean as it was kicking into looking ahead for spring. But in terms of what the actors actually got out of this, what did the actors win in this contract?
Yeah, so this is a contract that was valued at $1 billion, and it includes several positives for the actors, including above average minimum wage increases, a general hike of 7%, with background actors receiving immediate pay increases of 11%. Now, those minimums will increase by another 4% in 2024, and then by another 3.5% in 2025. We also have more protections surrounding artificial intelligence. Members will receive informed consent and fair compensation for the creation and use of digital replicas of members. And then for the first time, we're also going to see a roughly $40 million per year streaming residual bonus. So all in all, this seems to be a good thing for actors. Moody says it will cost the studios around $600 million annually, which at the end of the day, not too shabby considering we have production budgets in the $25 to $30 million range.
Not too shabby at all. Ali Kandahar, thanks so much for breaking that down for us. Let's do a final check of the markets before we let you go. As we head into the noon hour, we've been looking at a pretty flat trading day so far. You're looking at the Nasdaq right now, down 4 points, the S&P 500 down 4 or up 4, and the Dow up 110 points there, continuing to weigh on investors. That looming potential of a government shutdown, with Moody's downgrading the long-term credit rating for the outlook for the credit rating for the U.S., something we're going to continue to watch, and we'll also weigh on Treasury yields as well. That does it for Rochelle and I in this hour. Keep it right here at Yahoo Finance Live. Much more to come here.